2023 could continue to be pretty challenging for stocks.
Fixed income is back in 2023. You don't have to go out 10 years.
Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think.
As we move into 23, we're going to start the year with a coupon.
All in all, wages are likely to rise faster than prices in 2023. So I think the purchasing power is going to be there for consumers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Do you remember how to do this? Because clearly I don't.
Well, did you, how was the bus ride to Cornwall?
Did I get a bus?
You got a bus.
Is that the story you told?
It broke down halfway.
I went to Cornwall,
Yeah.
apparently. Is this another one of TK's stories?
Good morning, Happy New Year.
Okay, good morning to you. Hello 2023, live from New York City for our audience worldwide with Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Futures up right now by about 0.9% on the S&P. We'll catch up with TK in just a moment. I'll try and remember how to do this over the next 3-4 hours. Bramo, big question I've got to say coming into 23, hitting the ground running. It's not about the US data later this week. We'll talk about that. It's about China reopening and what we can expect from Chinese data in the future off the back of the decisions made over the last couple of weeks.
That's well said, because the data that we're getting is backward looking and it is horrendous. If you look at, for example, China Beige Book, it came out and actually was a prediction of a contraction in the fourth quarter for Chinese economy. That said, look at the subway activity data.
I saw the same thing.
That to me really says so much. We were looking at that in New York City. We were looking at that in LA in the aftermath of the pandemic, and that tells a different story.
A few questions here. Demand side, let's talk about that. Where's the demand going to show up? Is it going to be in the commodity market where people expect it to show up? Or have they stockpiled enough commodities through 2022 to maybe blunt that impact in the months to come? I don't know. The supply side question is more interesting to me. Are we going to get some supply side relief? Look at what's happening with Foxconn and Apple, and we'll discuss that in a couple of minutes' time. Or are we going to get supply side dislocations off the back of a boom in demand back into the goods sector, into places where we didn't see stockpiling?
It's a great question. It's very complicated. You already see an easing in some of the supply chain lines. Yes, the iPhone, but also in some of the German manufacturing data coming in better than expected. So at what point do we start to see that come through the crude market, come through the natural gas market, in perhaps a way that's a little bit more pressure for the
If you
global
would
economy?
like the guide to the next week or so, we have payrolls on Friday. Then after that, looking ahead to next week, you've got CPI data on the 12th visit. Then on the 13th, we get JP Morgan earnings as well. So you get your data and then you get your earnings. And we'll find out whether we're going to get the kitchen sink for guidance for the year ahead from the C-suite in corporate America.
Can they give a kitchen sink approach if we have no clue? Honestly, how much
Bramo,
are
I'm
we
with
getting?
you.
I mean, honestly,
I'm with you.
This feels like a black box to me. I mean, honestly, Michael Burry coming out and saying it's going to be a whipsaw inflation, it's going to come back, and other people saying just buy bonds, and that's what everybody else is doing this morning. I mean, honestly, it's incredibly conflicting.
We're trying to price a recovery to a recession that hasn't materialized yet.
Exactly. Go figure.
You figure that out.
You can go back to sleep.
Futures right now up about 1% on the S&P 500. I was surprised to see this in the bond market this morning, just logging onto the Bloomberg, just to see this bid coming into treasuries. Lisa, yields down by 13 basis points on a 10-year, 374 this morning.
Yeah, and how much is this based on what we saw over in Germany, that we saw better than expected data? We also saw a bigger than expected decline in some of the inflation read. At the same time, you're right. Maybe it's just that everyone said buy bonds. Everyone came back from holiday and said, okay, let's do it. Let's talk about what's going to happen in the week ahead, because honestly, today, everyone's just getting back to the office in the U.S. and getting their feet under them. On Wednesday, we get U.S. jobs opening data as well as Fed meeting minutes. That's at 10 a.m. and 2 p.m. respectively. The JOLTS data is going to be interesting. How much does it continue to come down? It is a jobs-focused kind of week. On Thursday, we get ADP employment at 8:15 and initial jobless claims at 8:30. Do we start to see a tick up in initial jobless claims? Because if you look at the longer-term track record, it does look like someone died and was put on one of those heart monitors. I mean, honestly, it has not ticked up, and you have to expect that you'd start to see that if
Only you could say something like that.
I mean, come on. It's just, but that's a good thing, right?
Just
we don't want the
suitably
initial
depressing from you. Look, I'm with you. For all the talk of recession, we've got 1.7 jobs open for everyone looking for one. According to the data, and we can talk about whether that data is worth looking at in that way. Jobless claims in and around 200K doesn't scream imminent disaster in the economy, does it?
Not at all. Although I do think that probably on Friday is the more important indicator. Not only do we get non-farm payrolls at 8:30 a.m., we get ISM Services Index for the December at 10, but the hourly earnings. Do you start to see it come down in terms of how much they're going up? That might be a more telling indicator, John, than even the just overall numbers of people getting hired or unemployed or job openings, because that gives a sense of how much real pressure there is in the market.
Came into the building this morning, had no idea where Tom was. I was told he was down at Eurasia Group and he'd be doing a top risk thing again in 2023. So TK joins us now from Eurasia headquarters. TK just abandoning us on the first day of 2023.
Yeah, Ian Bremmer out with his first top risk for the year, John, and that is that the Bramo gloom will drift into 2023. That's certainly what I've heard the last number of minutes. John, an annual tradition for surveillance to join Dr. Bremmer and Eurasia Group in celebration of their 25th year. Their top risks are a must-read. We're going to cover that, of course, on the war in Ukraine. Bill Dudley will join us with Dr. Bremmer, the former president of the Federal Reserve System of New York. And very much so, we will lead with China. Looking forward to talking to Dr. Bremmer, as you and Lisa mentioned, on China. We'll do that at the 6:30 moment.
That coverage will start in about 25 minutes. Looking forward to it, TK. I've missed you, Tom. Tom Keene, over at Eurasia HQ in New York. I'm not sure if that sentiment is shared.
I think
Tom.
it was. I think he was about to say it, but it was just on a delay, so
a
they
little
cut it
tear.
off and nobody could hear it.
I waited and then they just killed his mic. That's what I like to think anyway. Christian Miller-Glissman joins us now, Managing Director for Portfolio Strategy at Goldman Sachs. Christian, fantastic to catch up with you, sir. Happy New Year. Let's look ahead to the year ahead. Can you tell me how big is the gap right now between what you expect and what's priced in this market?
Yeah, happy to New Year to you as well. I mean, listen, I think not much happened over the Christmas period, which still leaves us with the same problem. Risk premia are very low. And I think risks are high. I think we are going to shift a bit from the inflation risk side to the growth risk side. You mentioned China. I think that's one area which could drive positive growth surprises eventually, but there's still a lot of uncertainty on the growth picture globally. So I think we're in the same spot where I think we see equities down in the near term, possibly recovering towards the end of the year. But I think the key challenge is risk premia are very low. Equity risk premia, credit spreads, the VIX, and that just doesn't leave us for a good start of the year.
Christian, you said that things really haven't changed, but one thing did change. It was incredibly warm over the past couple of weeks. And I know that that sounds like, okay, you had nothing else to focus on, but yes, and it has really allowed there to be an easing from some of the energy infrastructure, certainly in Europe. Doesn't that give you a more positive tone that some of the worst case scenarios haven't come to pass at all? And in fact, it's been better than expected almost across the board in every potential outcome.
Yeah, no, I think that's fair. I think certainly the kind of warm winter is something that can provide relief. We see that in the currency markets, like the pound, the euro has been remarkably strong over the holiday period, and the dollar has been weak. And a weaker dollar generally is also risk on. So I think it does feel like that is a positive. I'm not sure if I would extrapolate that and would make an investment thesis around that. The big challenge you always have is markets are priced for that already. It does feel like, as I mentioned, the currency markets have reflected that a bit. Volatility is low, credit spreads are low. So I always like the idea of mixing asymmetry with macro momentum. And I think macro momentum, as you said, has been maybe a bit more supportive in certain spots. But the asymmetry to chase that momentum right now doesn't look particularly good.
And Christian, you're not alone in believing that and seeing a better outcome potentially for bonds than stocks, that there's an asymmetry of risk here. And if you go into some of the havens, traditionally, it is better. But as John pointed out, we are seeing that haven bid today. We are seeing people pour into bonds. We're seeing people pour into the dollar. At what point do you say, okay, it's already priced in? What are the sort of the triggers to know, okay, this trades up?
Yeah, I mean, listen, yields have gone up in the last 2-3 weeks. I mean, real yields certainly in the US. And that means to me, to some extent, the fixed income opportunity is still there. I think at the margin, we are leaning to up in quality type credit. So we're not necessarily saying we would chase down the line riskier credits. But at this juncture, like TIPS, investment grade credit type yields, we think are still attractive. So there, the valuation is to some extent less of a concern. But you're right. I think this kind of outlook period has shown a bit of consensus with regards to fixed income. The other thing that does kind of give me a bit of comfort is the flows. I don't think we've seen a major rotation in flows out of equities into bonds, kind of broadly into fixed income. It's been reasonably slow. And that also tells me that we're not necessarily at the end yet.
Christian, can we just get into the China questions around demand and around supply as well, and start with demand? Where do you expect that demand to show up? Where is that Chinese capital going to be deployed? Where does the consumer go? Does it get spent at home? Does it get spent abroad? How are you and the team thinking about that?
Yeah, it's a really good question. I think we've been leaning towards the slightly more bearish story here with regards to the global economy, in the sense that we still have relatively tight commodity markets. And if China reopens forcefully and fast, you could see a bit of a replay of the commodity-led inflation, which we had coming into this year or the last year. So to some extent, we're kind of a bit more worried that it could reignite the commodity strength, which then has the kind of knock-on effects on inflation. With the travel bans, which have been put into place, the kind of exposure to global travel services and these type of areas is a bit more limited. So the Chinese economy itself seems to be very focused on growth, and there you're likely to see a decent recovery. But it could be very bumpy, as we learned in the last few days. Mobility has picked up from very low levels, and it could be very inward focused, not easy to invest.
So, Christian, I think the supply side is maybe the more complex question to answer right now. Do you see this as something that develops into supply chain relief or further supply chain dislocations off the back of that boom in demand?
Yeah, I think it's quite interesting. Our US economists, they actually expect goods inflation to turn negative this year. So I think on the goods side and with regards to supply chains, there is likely to be significant relief, and there's going to be less inflationary risk coming from goods and supply chains, it seems. And with China reopening, you could argue there's even more relief on that front. So it's still the services sector where there's a source of inflation, and the commodities parts. And from that perspective, that's more where we're looking for the data. You mentioned already, labor market data in the US is still critical, and anything related to commodities, if it's the energy crisis in Europe, or if it's China reopening, crowding out commodity markets. These are the things we're watching on the supply side.
Hey, Christian, this was great. Fantastic to kick off 23 with you, sir. Christian Müller-Glissman there of Goldman Sachs. There's going to be a massive debate around that, Bramo, about what actually develops in the year ahead.
Especially because it is so bifurcated between services and goods, and a lot of people expecting this disinflationary, outright deflation in goods. Does that mean that you get to this sort of rebound, kind of boomerang inflation later on?
Did you hear the IMF Managing Director,
yeah,
CBS?
I did.
Can you make sense of that? He said the three big economies, US, EU, China, are all slowing down simultaneously. Are they?
That's a great question. It's a really great question. Are they slowing down? Yes. But have we seen the nadir for China already?
Kelly Kaminsky coming up in the next hour. Looking forward to that conversation about 7 a.m. Eastern time. So let's call it 48 minutes away. Then TK, Tom Keene, sitting down with Ian Bremmer of Eurasia Group. We'll catch up with them in about 28 minutes. Live from New York City. Happy to be back. Happy New Year to you all. Future's up. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, the economy ended the year in a major slump. Business and consumer spending plunged in December, and more disruption is likely in the coming months as COVID infections surge across the country. Activity in China's services sector fell the most in almost 3 years. Ukraine struck a Russian military facility in an occupied town, killing at least 63 troops. It's one of the deadliest losses acknowledged by Moscow. Russia says the facility was hit by 4 U.S.-made HIMARS rockets. The U.S. is in talks with South Korea on ways to keep Kim Jong-un's regime from using nuclear weapons. The two countries are planning for a range of scenarios to deter North Korea. South Korea is seeking a greater role in managing atomic weapons on the Korean peninsula, but President Biden says he is not discussing joint nuclear exercises with South Korea. In the National Football League, Buffalo Bills player Damar Hamlin suffered a cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals. Hamlin is in critical condition in the Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics. The game was postponed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I have a working relationship with Kevin McCarthy, yes.
Do you think he's going to get the votes to be Speaker? You know.
I would be surprised if he doesn't. If he gets 218 votes, has the ability to put together the votes to be the leader of the party, and he will then be tested as to whether or not he can lead. But he's worked pretty hard at it, and it appears to me that he will be the Speaker.
If he gets 218 votes, that was Representative Steny Hoyer there, the House Majority Leader, to CNN. Live from New York City this morning. Good morning to you. Happy New Year. Let's get some price action for you. Your equity market positive. A lift on S&P 500 futures up 0.8% after a bruising, punishing 2022. How many different ways have we described that over the last couple of weeks?
Brutal.
What were we down by, Abramo? Down by that 19%? 19%
on the S&P. But
ugly.
The NASDAQ, even more significant.
Made even more ugly by the fact that the bond market participated in that sell-off as well.
Yeah.
And as we reset coming into a new year, I think that's where the question lies for everyone in fixed income. Is this the moment where you stop getting that move in tandem between equities and bonds, and that correlation, the one we're used to, reasserts itself?
The issue is that that's the consensus right now, and you're seeing that play out in some of the price action this morning, that bonds have an actual, some kind of valuation bid for individuals, whereas stocks perhaps not so much. How long does that last, though? How much is that really rooted in goods disinflation that we don't necessarily see in services?
We'll talk about that later. I want to talk about China reopening as well. Did you see what the spokeswoman for the foreign ministry in China said about restrictions being put up for Chinese travellers out of China into places like Europe, the United States? I'll read the quote. We believe that some countries' entry restrictions targeting only China lack scientific basis, and some excessive measures are unacceptable. Now, that's kind of dripping with irony for a lot of people waking up to read that, given what China's been doing over the last 2.5 years, Lisa.
No, yes, that is. I think a lot of people would say this is pretty rich, considering that other people have accused perhaps China's measures as not particularly scientific and not necessarily rooted in anything else. But I would say this, it is notable to me, aside from just the irony and the richness here, there is an aspect of what kind of tit for tat you end up getting with China as they try to communicate a very convoluted message to their population.
I've heard a lot of people tell me already this morning, look at the weak data out of China, look at the weak data out of China. I looked at the weak data out of China. I just think it's more important to think about where the data is going to be 6 months from now, off the back of the decisions that have been made over the last couple of weeks. Do we get that ugly phase of data like we got out of Europe, where social mobility starts to turn down because you get people self-sanctioning effectively off the back of a rise in sickness, you get people calling gout, have all those kind of issues, and then slowly, in the months still to come, things start to rebound, and then they rebound pretty quickly.
The people who were ahead of that and looking at the mobility data in the U.S., in Europe, they won. Remember, they were the ones who were ahead of a lot of the increase in economic data. So can you have the same kind of trade in China when there is a very different economic backdrop as well? It's not just COVID that's going on.
It's real estate too.
Yeah.
So how much weakness do we need to look through? We'll pick up on that a little bit later. As I said about 10 minutes ago, TK is going to join us in about 10, 11 minutes' time. He's going to sit down with Ian Bremmer of Eurasia Group on the top risk. I understand he's going to lead with a lot of questions on China. Right here in New York, we look down to D.C. with Anne-Marie Jourdain. She joins us now, our Bloomberg Washington correspondent. MH, fantastic to catch up with you. Let's start with that speaker vote face down, showdown for Kevin McCarthy a little bit later. Will he get 218?
Well, we just don't know yet, Jonathan, and that's what's so scary going into this vote for Kevin McCarthy. Remember, this is the first order of business for the new Congress, even before new members are sworn in. And Washington went to bed not knowing if he was able to clinch the votes needed. It's 218 if every member is present. If not every member is present, it could just be a majority. That's actually happened in the past with former speakers Pelosi, Boehner, Newt Gingrich. The issue McCarthy has, though, is that really this is infighting of the Republican Party. So even if he's able to clinch the speakership today, or potentially the next few days, because this will just continue until there is a speaker, unless they adjourn Congress, then this just paves the way and doesn't really exude a lot of confidence to the Republican Party, because he's already having to make some concessions.
Anne-Marie, what's the significance of this in terms of where the fissures are in the Republican Party and where the battle lines are being drawn?
Well, it just shows how much hold you have of these hard right representatives, really the Freedom Caucus. You have 5 who are coming out. These are really the no-never Kevins. You have others that really support Kevin McCarthy that are actually donating some pins that say, okay, okay, we're going for Kevin. So the never Kevins and the always Kevins. But these individuals of the Freedom Caucus, you have 5 who are saying outright, we are not going to vote for him. And then you have 9 signing this letter saying, we saw some of the rule changes he wants to make. One of the biggest concessions is making it a little bit easier to have a no confidence vote. But they're saying that there isn't enough concessions, and a lot of them aren't specific. So they want to see more proof before even he takes that vote to be Speaker of the House. But what this really shows is that down the line, it is going to be much easier for these individuals to have a hold on the party because they have such a slim majority.
So what does this mean for policy, Anna Marie? There's a lot of different political issues coming up in the next couple of months. Does this inform what the Republican power is going to be, even as their majority in-house?
I think what you can see in terms of policy down the line, and really September is going to be key, right? They have to sign off on another spending package or you can have a government shutdown. These individuals are really going to push for more hard conservative policies in terms of taxes. They want to make sure that the Trump-era tax cuts, which in a few years will be go-slided, they want to make sure that those continue. They also want to make sure that they are driving a very hard bargain when it comes to the fact that if the Democrats want to raise the debt ceiling, and obviously that's going to have to happen for a nation to conduct daily and normal financial practices, that they want to make sure there are concessions from the Democrats when it comes to spending. So that's going to be one of the key areas to watch.
MH, just quickly before you run, just a bit of a curveball. Did Secretary Buttigieg get to celebrate Christmas over the last week or not? Because I imagine the Department of Transportation was incredibly busy over the last several weeks.
I think it's fair to say his phone was blowing up, given the fact that so many individuals around the country were stranded in airports, not able to get home this Christmas. And that is one that he is still going to be dealing with this January 3rd.
Going to see the consequences of this, Bramo, for sure, in the months still to come. I heard some people talking about consolidation between JetBlue and Spirit. Is that going to get some pushback now off the back of what we experienced over the holidays?
Or not, if they can have some better, technological systems in play that don't leave people stranded. I mean, honestly, you could have either argument. I think the bigger questions for me are dividend payments, whether some of these airline companies can pay dividends without investing in better technological systems and perhaps better contracts with some of their workers. And then there's a question of what kind of responsibility is there for compensation to people who are left stranded in places, not just this, but like also, for example, in Atlanta for a weekend when you
horror
could
stories.
otherwise
Are you talking about?
I'm just
what
kidding.
airline are you talking about? You're talking about last year and your experience with that airline down in
whatever.
Atlanta?
Things
well, you brought it up. I didn't bring it up.
But
I
will
thank
say
Anne-Marie
this.
quickly.
Go ahead.
AMH, thank you. Carry on,
Okay.
Bramo, please.
I will say, I actually went to Denver, and I was not flying on Southwest. You could just see cancel.
It's ugly.
It's just like, it was horrible. I can't imagine.
These numbers, I went through them this morning, and thanks to the team here at Bloomberg for putting them together. According to FlightAware data, 15,700 flights. Southwest cancelled more than 15,700 flights. And you want the percentage? Almost 51% of its total flights cancelled December 22nd through December 29th. So that is brutal.
I was in the airport, and this person who is a very experienced member of the flight world said, it's kind of fascinating to watch how badly this all went. It was just a cascade of horror. I mean, it was one terrible thing after another. And the fact that they couldn't get it back up and running because of the point-to-point system rather than a spoken hub kind of system just highlighted how ridiculous it was. They were passing around pieces of paper to tell people where they were going to be flying to at different points. And it was incredible. It was absolutely incredible.
Would you trust them with your holiday travel next year? We'll see.
Well, for what price, first of all?
Well, that's it, isn't it?
And how many free drink vouchers?
You think that's what it takes?
I was actually
for me to put my holidays at risk of free
Not for
drink
you.
voucher. You think that's what it gets?
I just wonder how many perks they can actually offer people to bring them back with low prices, free drink vouchers.
The free drink vouchers thing, I just find nuts. I don't get it. What is it with drinking in airports?
Well, I think it's just such a miserable experience.
There's no social rules that apply. You
yes,
start
it's
drinking
true.
immediately, regardless of the time.
Absolutely, because it's somewhere, it's always 5 p.m., literally, and you might be flying there.
Ian Bremmer coming up next with Tom Keene from New York. This is Bloomberg. Live from New York City, good morning to you. Happy New Year. Here's the price action to kick off trading in 2023. Equities with a lift. I know many of you want to see a whole lot more of this after 2022. Equities up by 0.8% on the S&P. On the Nasdaq 100, up by, let's call it 1% higher. On the Russell, we advanced by more than 1% as well. In the bond market, 2s, 10s and 30s look like this. And I said it earlier, I'll say it again. I was surprised to see it. Yields at the front end down by about 7 basis points, 435. On the 10-year, 375.20. Yields down by more than 12 basis points. Maybe look to Europe. I have to say CPI out of Germany. Get this regional breakdown of CPI in Germany, then you get the headline for the whole country in about an hour and 30 minutes. And that's come in across the board, regionally speaking. So maybe that's contributing to this bid we see in the bond market, and maybe it contributes to this as well in the FX market. Euro dollar pulling back by 1.3%. Lisa, 105.26 on euro dollar this morning.
I'm not sure how it actually moves over to the strength in the dollar, because you would think that there'd actually be strength in the euro. It might mean that the ECB might not have to go as far if you are seeing some sort of disinflation. But what you are seeing here, and this goes to your question earlier, John, is the benefits of perhaps a bit of a reopening in China. Not a reopening, say, per se, in terms of just abandoning COVID-0, but the upside after the COVID spikes in some of the cities like Beijing and what that's doing to some of the supply chains.
A big story ahead. The geopolitics of this as well, just that back and forth between the foreign ministry over travel restrictions, I find.
You just want to keep going after that.
No,
huh?
I just think, come on.
It's a bit rich.
It's a little bit rich.
A little bit rich.
Just a little bit, yeah. Tom Keene with Ian Bremmer of Eurasia Group, the founder and president at Eurasia HQ. Morning, Tom.
John and Lisa, good morning to you. And it is what we do at the beginning of the year. We start strong with the top risks of Eurasia Group. It is a must-read, 27 pages of brilliance, far too optimistic this year on the comparative strength of America. And joining us with a brief throughout surveillance this morning, Ian Bremmer. Bill Dudley will join us on a divided America. We'll do that in a bit. But right now, not a divided China. Xi is at maximum power. Does it give way in 2023? Does his power after that Congress, Dr. Bremmer, does it ebb?
It doesn't. And good to be with you, Tom. Happy New Year to you. It's always good to be kicking this off with you. There's no question that both for China as the second largest economy in the world, but also with Xi Jinping having consolidated so much power in his hands and using it in ways that are capricious and are not in any way transparent. The global economy has never experienced anything like that. That level of uncertainty in the persona of one human being. We've seen it with the decision to do a complete 180-degree volte-face with the pandemic and zero COVID. We've seen it with $1 trillion off of market value of Chinese tech stocks because Xi Jinping decided that he was going to squeeze them. That level of uncertainty as China reopens their economy this year with no level of data that we used to get 5-10 years ago from the Chinese even is an enormously concerning issue.
This is important, and this goes to your colleague in crime on this, Elizabeth Economy at CFR, now with Secretary Raimondo at Congress. Economy told me years ago, don't overestimate Xi's power. Have we seen the maximum? Have we brought down, do we see him weaken, particularly off the COVID disaster?
We see China weaken a little bit on the global stage. Certainly the lessons they're taking for Taiwan, now that they've seen the United States and NATO in Ukraine, the lessons they're taking from concerns about American economic strength vis-a-vis China on semiconductors, for example, on the ability and willingness to impose export controls, and the fact that the Chinese have sat on their hands. Xi Jinping is not in the same geopolitical position he was in before the pandemic started. But politically inside China, he is only stronger. And that is the nature of the risk for 2023.
How does it permeate? Now, you lead with Russia in the top 10 risks, but how does China permeate out to all the other thinkings of the top risks this year? They just seem to dominate every conversation.
Well, it's not that the Chinese do it. It's something very specific does, which is that in a time that the United States democracy and economy is actually coming out more resilient and stronger than anyone out there would have imagined 1, 2, 3 years ago, we are seeing around the world a significant number of super empowered individuals who aren't getting great inputs from experts, who are able to act with impunity, and are not getting what they want in various ways on the global stage. Putin is one, Xi is another, the Iranian supreme leader is a third, and a small handful of tech centibillionaires are a fourth. And those individuals are driving a discommensurate amount of global risk in the marketplace right now.
Let's look at your work. G0, the concept of G20, G8, G7, down to a codified Bremer phrase, G0, or much more importantly for Americans, us versus them, is the basic drama out there. How do we prosecute in 2023 a foreign policy with G? Forget about Putin. How do we prosecute a foreign policy with China that gets something done 12 months from now?
Well, two different ways. On the competitive side, you lean into American strength, which turns out to be national security broadly defined. So in the same way that the Germans have made mistakes for decades, and the Europeans writ large, and letting too much of their energy security lean on Russia, the Americans have let too much of our technology national security lean on Taiwan 100 miles away from the mainland. Now, what we are now trying to do, not just for the United States, but with allies as well, is say we're going to redress that. We're going to redress it because of national security. So you, the Japanese, you, the South Koreans, you, the EU, the UK, the Canadians, you're all going to be with us on these export controls for anything the Chinese could use that would threaten our national security directly. And that's a policy that will align the G7 more broadly on China. That's important. But at the same time, Biden does not want to be in a Cold War with the Chinese. He doesn't want to fight over Taiwan. And he doesn't want the impact of competition on national security to bleed out into the broader economic interdependence of the two countries.
I'm looking for something new here, and I haven't gotten it from Secretary Blinken. I don't think I've gotten it from the Biden administration. Let's go back to something like the military-industrial complex. This is back when Tulane had terrible football, and they won against
USC. A year ago?
Yeah, a year ago. They stunned USC last night, which was great to see. But the shock of Tulane football, I'm looking for a shock in the Bremer world. In your top risks, what's the thing our viewers and listeners have to look for 6 months and 12 months from now?
Well, the shock that comes from a Chinese leader that is making policies. I mean, the end of zero COVID, a lot of people thought that it was going to be incremental after he secured power for that unprecedented third term in the party Congress. He didn't move away from it at all. No, it shocked everyone. No one was expecting this even 3 months ago, even 2 months ago. Why? In response to sudden demonstrations, the information got to him, and he, as an individual dictator of the second largest economy of the world, made that decision. We're going to see more uncertainty of that kind from the most powerful individual on planet Earth in 2023. Putin is in a corner.
I want to finish up here on China because we're going to talk to Bill Dudley later. We're going to talk to Mr. Rudd of Australia later. And, of course, focus on Europe. We'll do that, folks, here in a bit with Carl Bildt. Okay, fine. But is the chemistry of China changed? The history is it's city-states like Shanghai and the new Hong Kong and all that versus a federal Beijing.
That's right.
Is that traditional calculus still in place?
Haven't seen it since Mao, what's happening right now. And at the time of Mao, the enormous amount of uncertainty in China didn't matter to the global economy. They weren't interconnected to it, and they were vastly less powerful. We today have the same level of concentration of power that you had during some of the worst episodes, chapters of Chinese history.
How should the U.S. respond to that concentration, the autocratic power?
With confidence, but also with strategic patience. In other words, take shots when you know they are important with allies strategically. The new policy that you see from Biden is on semiconductors and export controls. That is containment at the sea change. But in other areas of the economy, don't allow that to dictate what you're doing.
We've got 1 minute here. We've got to get back to John and Lisa on the markets. Very, very importantly here, do you see a rekindling of what I'm going to call from World War II a MacArthur isolationism?
No, not at all. Not at all.
The Republicans don't want that?
It's not that they don't want it. It's that everyone that throws money around in the United States strongly wants to ensure that doesn't happen. Furthermore, no American allies on the global stage want it. Not one. Not one. Not the Japanese, not the Europeans. Biden cares about that.
30 seconds. John Ferro demanded I ask you this question. You nailed Merkel in Germany 2 risks ago, top 10 risks ago. Did Merkel fail in Germany? Did Merkel, is the reason we're where we are in Europe right now, to tease to Carl Bildt, is it because Merkel failed?
Merkel failed on energy policy, and now they are paying the price for that. The European Union is stronger today, in part because of work that Merkel did. So you have to give her a middling grade.
Got to tease what we're going to do with Dr. Bremer here. Eurasia Group, they celebrate their 25th anniversary, and very importantly, their top 10 risks. And John, the 11th risk that Eurasia Group came up with was that Tottenham would somehow find an offense.
Have you got some match analysis from
somewhere.
Eurasia Group HQ, Tom? What's the match review?
It's out there. The match review is kick the ball from far out.
Okay.
Aston Villa killed at that.
Looking forward to the coverage through this morning.
Risk.
TK, fantastic work as always with the Eurasia Group President Ian Bremer. Stay tuned. More still to come from Eurasia throughout the morning, including interviews with Carl Bildt, the former Prime Minister of Sweden. We'll catch up with Bill Dudley, good friend of this programme, the former New York Fed President, Kevin Rudd, former Australian Prime Minister, coming up a little bit later as well. Looking forward to all of that. Bramo, just on China and what's going to happen with the Fed. And we've barely mentioned the Federal Reserve through the first 40 minutes of programming. So for those of you interested, first meeting of the year starts the end of this month. Decision the first of next month.
I think there probably are a lot of people who are very happy that it took this long for us to mention the Federal Reserve. I do wonder whether this year it's actually going to take a back seat in some respects, just simply because the real economy has to take over. What happens if they just stop hiking and we stop, obsessing over their every move, and we actually just start focusing on...
Oh, you think we might be able to?
I think.
Can I give a shout out to Anna Wong of Bloomberg Economics,
who
last summer said that the terminal rate could hit 5, and I think a lot of people were still laughing at the time. And here we are talking about a terminal rate likely to hit 5 at the Federal Reserve this year. Yeah,
and I think that a lot of people are expecting it to stop there. I don't know if we're going to start to hear, and I suspect that we will, a shift away from some of the tone that we're going to have to overshoot to 5.5% or 6%. And I'm very curious what Bill Dudley has to say on that, because there's a feeling that perhaps the price levels are really coming down faster than people expected on the good side.
We'll see. We'll get CPI next week on the 12th. Then you get some earnings from JP Morgan on the 13th. Before we get to all that good stuff, you've got payrolls coming up this Friday. Equity futures right now on the S&P up 0.8% on the S&P 500. Yields are coming in. Big bid into the bond market to kick off 2023. Yields down 12 basis points. Your 10-year, 3.75.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill, Kevin McCarthy's chances of becoming Speaker of the House remain in doubt as Republicans prepare to take control of the chamber. The GOP will hold only a slender majority when the new Congress convenes today. McCarthy can't afford to lose more than 4 Republican votes, and he's opposed by a number of hardline conservatives. IMF Managing Director Kristalina Georgieva expects a third of the world economy to be in a recession this year. She told CBS News that's because the 3 big economies, the U.S., the EU, and China, are slowing down at the same time. But Georgieva says that if the resilience of the U.S. labor market holds, that would help the world get through a difficult year. More troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers, they plan to strike later in the month. Unions are demanding bigger pay hikes to deal with record inflation. In China, Foxconn has bought the world's largest iPhone plant back to about 90% peak capacity. That suggests that Apple's biggest production partner now has enough workers despite a COVID outbreak and a staff upheaval. In November, thousands of workers at the facility either left or staged protests against extreme COVID restrictions. And pro rally driving legend Ken Block has died in a snowmobiling accident near his home in Utah. Block co-founded the skateboard brand DC Shoes. Later, he began driving rally cars and revolutionized motorsports filmmaking. Ken Block was 55. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We expect 1/3 of the world economy to be in recession. For most of the world economy, this is going to be a tough year, tougher than the year we leave behind. Why? Because the 3 big economies, US, EU, China, are all slowing down simultaneously.
That was the IMF Managing Director speaking to CBS over the weekend. Equity futures right now rolling over. We're positive still, but we were up by about 1% on the S&P not so long ago, about 20 minutes ago. On the S&P right now, we're up by 0.4%. There's that line on China slowing down from the IMF Managing Director. I mean, Lisa, sure. But for how long and how quickly are we going to bounce back later this year?
Right. Have we already seen the worst of it? And if that's the case, what kind of offset does that give to emerging markets? And ironically, a lot of investors are betting against Kristalina Georgieva and saying, actually, this is the place to bet. Exactly.
Never.
Okay, you're dripping with
Great
sarcasm
start
this morning.
to 23. Tom Keene at Eurasia Group HQ with Ian Bremmer and a special guest. Hey, TK.
John Ferro, thank you so much. This is the lead of the top risk this year for Eurasia Group, and no surprise, it is on Mr. Putin and on Russia. With us, Dr. Bremmer, and joining us as well, someone with a European and Russian perspective. Carl Bildt is the former Prime Minister of Sweden. They are very much in the news, but with all sorts of other public service to his continental Europe. Dr. Bremmer, I want you to brief in here before we get to Carl Bildt. There is an understanding of Finland and Sweden on down to Turkey, this border which you've talked about at Eurasia Group for years. What is that border, that Eastern Front, whatever you want to call it, what does that view look like from a rogue state of Moscow, a rogue state of Russia?
Yeah, well, it looks a lot worse if you're a rogue state, if you find the present global order unacceptable, and if you find that you're being humiliated through acts of your own, and trying to get yourself into a better position. What it means is that NATO is seen as aggressive. It is expanding. It is more forward deployed. And Ukraine, a non-NATO country, increasingly has the best supplied, best deployed, best trained, best intelligence of any military, best capacity of any military on the ground in Europe. It could not have gone worse for former President Putin. And that border only looks more problematic when you, as Russia, do not have any military strategy to countenance it in 2023.
A good summary from Eurasia Group there to go to Carl Bildt, again, the former Prime Minister of Sweden. Mr. Bildt, thank you so much for joining Bloomberg Surveillance today. Carl Bildt, how alone is Vladimir Putin?
I think he's increasingly alone. I think we should understand that the decision that he took on February 24th last year to launch this particular war was a decision taken by him. I think it was a very, very closed circle around him that was fully aware of his intentions. And of course, that decision was then grudgingly accepted by a lot of the Moscow elites, however you phrase that, in the belief that he would actually succeed. But what has been happening since then is, of course, that he has gradually failed with the one part of the strategy after the other. And that means, in my opinion, that he's increasingly isolated in Moscow without that necessarily being an active opposition as of yet, but a lot of uneasiness around him.
Carl Bildt, the tension that Mr. Putin enjoys and likes is, say, personified in your Sweden and Turkey. The distance from Sweden to Turkey has been noted throughout this war. How do the allies coalesce around one voice? What is the process this year to rebut this rogue state?
Well, I think the last year has been, and I think you'll see continuation of this year, very impressive in terms of European action, solidarity, and transatlantic bonds. I don't think, or I'm fairly certain, that Mr. Putin had not counted on that. He had counted on the Americans not being too engaged following what happened in Afghanistan. He had counted on the Europeans being divided, which sometimes happens. And he had counted on the Ukrainians not being too vigilant in supporting their independence. On all of these counts, he was fundamentally wrong. And now he's gradually paying the price.
What do you need from President Biden, from Secretary of State Blinken, from a new American, particularly with the American politics that's new here into a presidential campaign? What do you need from America to steel for a long war?
Well, the continued American support, both in political and military and financial terms, is very important. The European and American support is now roughly equal, but on the military side, the American support is, of course, much more important. And the political leadership that has to be given by the president and the White House has been important in order to mobilize global opinion. And we sincerely hope that that will, and there are no indications to the contrary, that that will continue to be the case during this important year that is now ahead of us.
Ian Bremmer, we deal with someone there who's just still in the pragmatic reality of European politics. I want to dovetail that with a new movie that's coming out, All Quiet on the Western Front, another treatment of a classic book, a classic movie from another time. How can America assist Europe if a large part of America really doesn't want to be involved in Europe like we didn't want to be involved in 1913?
Look, the first American LNG is making its way to Germany today. The United States is doing an enormous amount. They're by far the biggest military supporters of Ukraine in the world today. And American technology companies are by far the most important national security supporters of Ukraine in the digital space, in the cyberspace, in the virtual space. That's enormously important, too. That's not being paid for by the American taxpayer. Now, you put all of that together, the risk in 2023 is not that it falls apart. It's not going to fall apart this year. The risk is that Putin increasingly losing on the ground from a national security perspective, a military perspective, an economic perspective, and a diplomatic perspective, with no friends, becomes like a global Iran. He is the most dangerous, most powerful rogue actor that the planet has seen in your and my lifetimes. And his willingness to go after NATO, to use asymmetric attacks when nothing on the ground or even in the air increasingly works against a well-defended Ukraine, that's the risk for 2023.
Did Donald Trump get out front of this by questioning NATO and their commitment to their investment in NATO? Was Donald Trump ahead on this?
He helped Putin believe that there would not be a united response. Trump's America First helped lead to Macron's more rhetorical strategic autonomy for France and saying that NATO was brain dead. If you're Vladimir Putin, after 4 years of Trump, you increasingly believe, for reasons that Carl mentioned, that the United States and the Europeans wouldn't care about Ukraine.
We need to consider this further here. Carl Bildt, thank you so much for joining us, the former Prime Minister of Sweden, and we'd really like to get you on surveillance again here in the coming weeks as this story unfolds. John, I saw the news over the weekend, or really overnight almost, on Ukraine's attacks on troop levels in Russia. And again, this war may be off the radar. No, this war continues.
You remember, Tom, 9 months ago, we were talking about maybe it lasting a couple of months, and here we are, staring down the barrel of another year of it in 23. TK, great to catch up. We'll catch up with you, I think, in about 30 minutes' time. Looking forward to that. Surprising last year for me. Lisa, Brent crude only up by about $8 a barrel on the year after everything we saw take place.
Yeah, everybody was a bull except for Citigroup, and Citigroup was correct, at least in terms of the scope of bullishness. What does that mean for the why? Are people really traveling that much less? I mean, if you go on the roads, if you go in the airports, does it feel like people are actually less mobile? It doesn't feel like that to me at all.
Q4, do you want the forecast for this year on crude? Q4 23, WTI, the forecast, the median is $77 based on our survey. Brent crude, the forecast is about 81. Q4 23. You can find that on CPFC on the Bloomberg terminal if you are a subscriber. So, Lisa, basically what we're saying based on these forecasts, the median for whatever that's worth, is that crude's going to end the year basically where it is right now. Does that add up? I want to find out what happens with China. I mentioned this a couple of times. So you've got China on the supply side. I think there's a real conversation to be had about whether we get further dislocations because of the demand or whether you get supply chain relief. Look to Apple and what's happening with Foxconn overnight. On the demand side, where does the demand show up? Have they stockpiled enough commodities through 2022 when demand was softer to maybe avoid that big kick higher in prices this year when China really gets going?
Once upon a time, it was like a couple months ago, we were talking about how weather would actually matter a lot.
It does in Europe, sure.
It has mattered a lot. And I feel like we're not talking about it enough. And how much is weather the reason why gasoline prices or oil prices or natural gas prices are where they are, where you're seeing the big plunge? And how much could that reverse if that changes, right? I mean, this is the question. Where is the peripheral demand? China comes back online, a little bit of cold weather. How quickly do things rebound?
Live from New York City this morning. Good morning. That conversation is going to continue. Equity futures on the S&P 500 roll over just a little bit. We're positive 0.4%.
2023 could continue to be pretty challenging for stocks.
Fixed income is back in 2023. You don't have to go out 10 years.
Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think.
As we move into 23, we're going to start the year with a coupon.
All in all, wages are likely to rise faster than prices in 2023. So I think the purchasing power is going to be there for consumers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Hello 2023, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive by about 0.4% off session highs. Economists lining up to call for a recession in the year ahead, Bramo. Really warm, fuzzy stuff, isn't it, going into the year ahead? And get long bonds. You heard it again and again and again in that opening sequence. Bonds are back.
Which kind of makes me, and I know that this is kind of counterintuitive, but I'll feel a little bit more optimistic. And I know that that's really strange, but, you know, you have to think that if everybody's expecting Armageddon and you're getting better than expected data and you aren't seeing some of the worst case scenarios, does that actually mean you can lean against that at least for a couple of months?
A tweet of the morning so far. Do you want to hear it?
Mm-hmm.
Why does Mama Bear sound so bullish on the first trading day of the year?
That's
I
the
wonder
reason
who
why.
that tweet is about this morning.
Look, I'm looking at all of this, and you see better than expected outcomes when it comes to a warmer than expected winter, when it comes to a reopening in China that, yes, is messy, but you're starting to see that mobility data change. How does that really counter some of the real bearish narratives, especially when the consumers are still spending, when you're still seeing wages going up? How much does this really create a complicated narrative that goes against some of the consensus
We
right now?
get an early look a little bit later this week about some of the data. Through this week, get a ton of it. Then you get payrolls on Friday. Then on to next week, just your guide into the rest of the year, I guess. On to next week, we get CPI next week on the 12th. JP Morgan earnings kicking things off on the 13th. Then you get that first Fed decision, starts at the end of this month, that meeting, the decision on the first day of next.
I'm curious to know the balance of risks when we get that CPI report. Do markets respond more violently to a downside surprise or an upside surprise, right? This idea that perhaps inflation isn't coming down as quickly or is coming down even more quickly than people expected. What does the Fed do with that? We're not expecting Fed rate hikes, but do we start talking about potentially a lower terminal rate in a more concrete way?
Neither of us have the answers, but let's ask the right questions, and you're going in that direction. We've had the conversation about how high at the Federal Reserve. Conversation shifts now to how long do we stay there once we get to, say, 5%, if we even get close to that level? How long do we stay there? Because when it comes to inflation, yeah, peak inflation, sure, done. Cool, whatever. Come down to what? 5 and stay there for how long? How sticky is this story going to be? Is it too early to move on and say, yes, 23 started, line in the sand, arbitrary date. I'm done with looking at inflation. Now I'm going to look at growth. That's kind of the story that's being sold on the street right now, isn't it?
And I'm going to be a little bit counterintuitive here and say, how much does this really depend on oil prices? How much are people going to look back on 2022 and say it was a commodity boom that people mispriced and that faded in 2023? Or does it not? Does it actually rear its head, especially with China's reopening?
Equity futures right now, positive by a third of 1%. For those of you just tuning in, just waking up perhaps, we were much higher than this about an hour ago. We were higher by about 1%. So equity futures might be positive now, but they have been rolling over, at least for over the last 30 minutes or so.
You have to wonder what liquidity is doing, especially with such a big move in bonds. I suppose that the equities have gotten with the bond story, which is the bid into bonds, tends to be gloomier. So I guess people are fading. I'm not going to give it a narrative. Who knows what's going on here? It's the first trading day of the year in the United States. We're looking at this week, Wednesday, you get U.S. job openings data. I'm really curious to see how quickly the number of openings per each employee in the United States keeps coming down. We know it's been incredibly inflated. Is this a sign of early loosening in a labor market that has been ultra tight? Thursday, we get ADP employment data at 8:15 a.m. Initial jobless claims at 8:30 a.m. We have seen really very little increase in the people filing for jobless benefits. Is this something idiosyncratic about the nature of the employees laid off, that they're getting severance bonuses or that they're getting some sort of gardening leave? Or is this simply, again, that this is a market with far too few workers for the jobs that are needed to be done? And Friday, we get the real read on the employment picture in the United States, 8:30 a.m., non-farm payrolls. How much do we see average hourly earnings continue to expand? Do we see a deceleration in the pace of that? If not, what does that tell us, right? How do we interpret that data at a time of really convoluted messaging with respect to the services side and the goods sides of the economy?
Can we just ban one chart early in 2023?
Which
Jobless
one?
claims over 5 years. The pandemic broke the chart. The chart's just useless now.
Well, it isn't. It's not.
It's useless.
It's not useless. I disagree. We can debate this in the break.
Why is it useful?
It's useful because if it ticks up, you can start to see it. But it just shows
you
how
won't
big
be
of a
able to
dislocation it was.
because claims just exploded in the pandemic. The chart's broken.
Okay, well, thank you for that input.
It will look like
I will
a
take it into
100,000
my...
move, which is going to look like that on the chart.
I'm going to take it into consideration, but there was nothing. It's flatlined.
It's going to look flat. Anyway, we'll talk about this later. I don't want an argument early in 23. TK's going to do that for us. He's over at Eurasia HQ this morning. Tom, looking forward to the conversation in about 25 minutes.
Was that the first domestic of 2023?
That was the first one, Tom. Early days, I know.
Oh, yeah.
It's good. Well, we're going to have to see. What we are doing is celebrating the work of Eurasia Group, their 25th anniversary, and their top 10 risks. And, John, this time we're going to go to what Ian Bremmer calls a divided America, a divided outlook on our economy, a divided outlook on a Federal Reserve view to 2024. We'll do that with William Dudley, writing for Bloomberg Opinion, of course, the former New York Fed president. Kevin Rudd with new duties for his Australia. The former prime minister will speak of that Pacific Rim. And Marietta Schottky will join us at Stanford University, truly an articulate voice on the future for Europe. With none of these, John, are we going to... I'm not even going to have a domestic with Ian Bremmer. I'll let Bramo handle that. She seems a bit tense, John.
No, bullish, Tom. I'm just not used to it. Just to see Bramo bullish for the year ahead. I don't know where it's coming from.
Kind of poke some holes in it.
Don't.
Well,
Tom,
it's
looking
okay.
forward to the conversation a little bit later.
It's a new year.
I think we're on the same page about a load of things. It's just that one chart. Just wondering
I'll
if it's
take
useful.
it into consideration.
Okay.
You know, I'm going to give it a lot of thought to this over the week.
Okay, please do. I'm sure it'll really take up much of your time.
We'll have a dinner time conversation about it.
I've missed you, Bramo.
I've missed you too.
Sure.
I have.
Katie Kaminsky, Chief Research Strategist, joins us now at Alpha Simplex. Katie, this line jumped off the page for me, and Happy New Year, by the way. Great to see you. This line here, short bond signals remain. Katie, we've got the whole street lining up to say buy bonds, buy bonds, buy bonds, and you're saying short bond signals remain. Katie, why is that?
Yes, I mean, you know, I'm always a contrarian in this particular bit. And what's been interesting is last year we had a ton of short signals, but the only one that seems to be somewhat persistent going into this year is short bonds. And that's really because it's a contrarian signal. It's something that few people really want to or feel that confident with. So that's where the technicals and the fundamentals and people's opinions seem to be very different.
Well, Katie, and this speaks to the reason why perhaps I'm going to get hammered for seeming not as pessimistic this morning, perhaps by some people, because it seems like everybody is saying buy bonds, things are going to be rough, it's going to be a really rocky economy, and it'll be a tough picture for earnings. But that's not being ratified by the data, which is coming out stronger than expected, which might actually move against bonds and for equities. Is that really what you're seeing?
Exactly. And we're also seeing positive correlation between stocks and bonds. And I think people are ready to call this bond bottom over already. And I think we still have some time if we have to keep fighting inflation at such a high level. I know we're past peak inflation, but we're still not really at the target. So I think that's where people's hope and sort of where the market might have to go this year may be different. We're still much more positive than we were last year, but the bond bet is the one that remains.
And there's a real issue here with not conflating optimism in the short term and optimism over the long term. Katie, is this a view, and I know that it's a technical trading kind of strategy, but is this something where we're going to avoid the worst of a downturn, or we're just not going to get it yet? Is it a timing issue, or is it a paradigm issue?
That's a good question, because we sort of think about the markets more from a technical perspective. And what we've seen is a massive consolidation and risk construction. Basically, risk has been constricting and people have been taking less risk off the table in the last quarter. And then what we're seeing now is the market has really not decided what the next trends are going to be, with the exception of short bond signals still being relatively strong. So from that perspective, it seems like we need to navigate the difference between the longer term narrative, how do we get over the higher inflation numbers, versus things are looking better. We're past peak inflation. China is reopening. So it is really sort of very, very mixed right now.
Katie, how are you thinking about that China reopening story, not just from the demand side, but also from the supply side as well?
Well, the China reopening story should be directly linked with oil prices, but you haven't really seen that yet. And that's where I agree with some that it's going to take a longer time than just sort of an overnight change. And there's a lot of complexities in terms of how supply and demand dynamics have changed post 2020. So I think it is going to be a positive theme, but it may not happen as quickly as some people expect. Thus, oil prices may go up again at some point later this year, but there doesn't seem to be indications of that yet.
So, Katie, my question would be, as we start to get a soft patch of economic data out of China, and we've seen that in the last couple of days, Katie, do you ignore that? Do you look through that in the hope, the expectation that at some point further down the road in 23, it bounces back?
Yeah, I mean, I think the impact of these measures and the impact of any sort of slowdown or constraints takes a lot longer to see. And that's the same narrative we're thinking about for the US this year, is what is the impact of rising rates? What is the impact of all these, of inflation in general? It's not something that's very clear. It's much more opaque, and it takes time to measure. And that's why data is so important, and people are so fixated on that data. I think it will take, you can't ignore the shorter term data. You have to take it all into account.
Hey, Katie, great to hear from you. Tremendous performance from you and the team in 2022. Congratulations for that. Katie Kaminsky there of Alpha Simplex, looking back at last year and what we got and looking ahead to the year ahead and looking potentially for inflation to be a little stickier here and maybe not jumping on that bandwagon to buy bonds.
There's a lot of other voices behind that view because of services. That's why it's going to be important to watch wages. I mean, if people are getting paid, why not, I saw Vegas occupancy is back to pre-pandemic levels.
Read the piece from Ashworth and Gilbert on Bloomberg Opinion this morning on the bond market.
I will do so.
350 year end is the average forecast on a 10-year. Right now, 377. Their take, that strikes us as unlikely. Either transitory wins the day and yields decline, or increased friction in global trade keeps consumer prices and bond yields rising. They kind of go through things thematically, piece by piece for the year ahead. It's a great piece out on Bloomberg Opinion this morning. Futures up by 0.25% on the S&P. On the NASDAQ 100 up 0.4%. Happy New Year, and we're going to play that game. For how long should you say Happy New Year?
I think after today it's over.
You think one day back?
It's 2 days.
What if you haven't seen people that you love for a couple of days? And it's like January 10th. You're not going to say Happy New Year. What if they say it to you?
Well, then, no. Then you tell them that you thought that their chart was crap, and then you tell them that they should really reassess it.
Can you say that word on TV and radio?
Actually, I think that. I don't know if I'm going to be here next
You should apologise to people who might have been offended by the language that we used just seconds ago.
Happy New Year.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Disgraced crypto founder Sam Bankman-Fried plans to plead not guilty to fraud charges today. He's set to appear in federal court in Manhattan after being charged with orchestrating a years-long scam at crypto exchange FTX. Two of Bankman-Fried's closest associates have pleaded guilty to fraud and are cooperating with the government. In China, the economy ended the year in a major slump. Business and consumer spending plunged in December, and more disruption is likely in the coming months as COVID infections surge across the country. Activity in China's services sector fell in the most in almost 3 years. Ukraine struck a Russian military facility in an occupied town, killing at least 63 troops. It's one of the deadliest losses acknowledged by Moscow. Russia says the facility was hit by 4 U.S.-made HIMARS rockets. In the National Football League, Buffalo Bills player Damon Hamlin suffered cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals. Now, Hamlin is in critical condition in a Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics. The game was postponed. Meanwhile, Axios reports that a GoFundMe page for Hamlin's charity raised more than $3 million in a matter of hours. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I do not believe that Donald Trump should be the next president of the United States. I think he's had his opportunity there. I think January 6th really disqualifies him for the future. But I want to see everything I can do to make sure there is the alternative and that Donald Trump is not the nominee of the party.
That was Governor Hutchinson there of Arkansas. We'll get back to that in just a moment. From New York City this morning, good morning. Happy New Year to you all, just tuning in on TV and radio. Here's some of the price action for you on the S&P 500. We are elevated positive, just about, by 1/3%. Bramo has tuned into 2023 and apparently is bullish for now. We'll see how long that lasts. On the NASDAQ, up 0.5%.
Okay,
sure.
It's going to be nuanced. It's not altogether bullish. It's just that the balance of risks right now, based on where people are, is that there's an overconfidence that bond yields are going to go lower and that stocks are also going to go lower. And that's all my observations.
So short-term constructive on equities and what on bonds?
I just don't know that yields are going to go down as far as people think. There's some calls for, 2.5%, 2.8% by the end of this year on a 10-year. And I'm just wondering whether that actually is matches with everything else.
Have you sent Steve Major of HSBC a note, who's at 250, I think, year end?
No, I haven't sent him a note, but we'll have a discussion about charts.
Yields are down by 10 basis points this morning. If you're interested in what's happening in the bond market, over in Germany, had this regional breakdown of German CPI. Most of it came in softer than the previous month, and we're anticipating maybe in about 42 minutes, Lisa, we get a softer print from Germany. Is that what's enticing people to buy bonds this morning?
That's got to be part of it. It also has to be that everyone's gotten back and realizes that the consensus is to go buy bonds. But I do think that, that is part of it, is that the data has come in softer, that the reopening of China so far has eased supply chains, but hasn't caused gasoline or oil prices to rise all that much. So at some point, this seems like a goods disinflation story is overwhelming some of the other aspects, even though employment still is very tight around the world.
I talked about Apple briefly a few times this morning already, Foxconn. They're at 90% capacity.
Yeah, they're right back where they were.
That's the good news. That's the relief. Then we need to get back to the potential dislocations. If you get that surging demand like we did out of the West into an economy that maybe can't provide the goods, do we get a return of goods inflation in a few months' time?
January 21st, that's the Lunar New Year when you start to see some of the travel patterns over in China. They have been absolutely moribund since the pandemic. If you start to see those pick back up, is that your signal that you're going to start to see crude demand start to pick up? Natural gas demand will actually end up being something more significant on the other side of the equation.
Is there any signal here from China's new foreign minister? I've been deeply impressed by so many hardworking, friendly and talented American people that I have met, adding that he had made many friends across the United States in a tweet. What did you make of that?
It's a very different tone. It's a very different tone for a Chinese foreign minister.
Just a bit.
And it's gone from, we're competitive and something more combative to we love each other. We are friends.
I don't know if it's going to go that far.
Well, but it is a notable change in tone.
Let's get to AMH down in Washington. Our Washington correspondent, Anne-Marie, joins us right now. AMH, is a change in tone. OK, it's a change in tone. Is it a change in policy on the horizon, a change in approach?
Well, there's one notable change in policy, which was, of course, that climate talks had stopped after Speaker Pelosi visited Taiwan last year. That already started. Obviously, you had also in November Biden sitting down with Xi Jinping and China, and that communique signed their name, and it said most countries were against the war in Ukraine. But at the moment, nothing has actually concretely changed on one of the biggest tensions right now between these two countries, which is, of course, the fact that the armies are not communicating, but also the fact that China has not condemned the war in Ukraine, and they continue to support Russia economically by buying and continuously buying their fossil fuels. But it is notable that China has picked as now their top foreign policy voice who was their top envoy in the United States. And what he said is that he wants to continue building on that relationship. So that does seem that that is a bit of a warmer tie. And also the fact that early this year, we're set to have Secretary Blinken head over to China. That could be another window potentially to boost these ties, which really hit a very low point over the summer when Speaker Pelosi did visit Taiwan.
There's a question about leverage, Anne-Marie, and whether perhaps the balance of concerns for China has shifted in favor for perhaps hoping for more economic support than just worry about some of these nationalistic kinds of goals that Xi Jinping previously had. I mean, how much are Washington officials saying this marks a greater emphasis on the economy and a greater easing in the relations on that front because of that focus for China?
Well, for China, the economy is front and center. Obviously, that's been a case not just because what they're suffering in terms of the COVID-19 lockdown and the supply chain havoc, but the fact that Trump-era tariffs are still in place. These are things they want to be lifted. They want access to the U.S. capital markets. There is a lot of concern in Washington about these issues. The fact that China has access to the U.S. financial system, the fact that TikTok is becoming a primary source of news for a younger generation, and obviously that is owned, their parent company, ByteDance, is a Chinese-based company. These are a number of issues that China is focused on, expanding their economy, making sure that they have this strategic partnership with the United States. They want tariffs lifted, but the U.S. is nowhere near there. So I think John's question at the start, it sounds warmer, but are there a ton of changes? Not exactly.
You on TikTok, Bramo?
Actually, no, I don't do TikTok. Do you do TikTok?
No, absolutely not.
Did you see that TikTok is number 9 on Eurasia Group's list of potential
What
risks?
does it say?
That basically, it's actually not that it gets banned. It's that it has organizational power, where Gen Z can actually organize and create real headaches for some of the elected officials.
What, here in the United States?
Everywhere,
or in
globally,
China?
everywhere, around the world.
They're going to form their own Politburo.
Yeah, making life harder for multinationals everywhere, disrupting politics with the click of a button and creating their own Politburo.
I find the TikTok thing nuts, the fact that we're still sort of dancing around the issue.
You mean about why the U.S.
Congress can't get its act together on it, that the former president tried to make a drive there and ended up going absolutely nowhere.
Well, you lose the support of an entire generation that, and I will say this, guilty as charged in terms of my progeny, but are addicted to this thing. And so how do you then basically say, you know what, we don't want to do it? I mean, there is a disbelief that that people can be manipulated through TikTok. And I actually have had this conversation.
People would like schools to be teaching about the dangers of communism again. That's what they'd like. We talked about this briefly before. AMH, thank you. That was great. Anne-Marie, good to see you down in Washington, D.C. Anne-Marie there, down in Washington.
She was down in Washington.
Are we going to have that conversation a little bit more this year?
I don't think...
I don't think Gen Z cares one bit about what's behind that platform. Not one bit.
There is less, from my perspective, and this is the dinner time conversation that we have at home.
What are they saying?
I care less about communism versus capitalism versus whatever you want to say ism. My issue is, do you have an understanding of what type of manipulations could be coming at you through the images and through the news that you get? Is there a sense of how you could be informed by some of these social media platforms? And I will say that it goes for not just TikTok, but more broadly, right? If you don't have a consistent method of where you get the information, I realize it's rich for me to be saying this as a member of the media, but I do think that this is something that is a really important question at a time when so many young people are getting their information through some of these social media companies, especially one that could be dominated and manipulated, theoretically, by a foreign power.
Why do you think US social media companies can't get any traction in China, can't get China to open the doors and let them in?
Okay, this is a rhetorical question. You know, they're all banned, but yeah, they're banned, yeah.
No, it's not a rhetorical question.
Yeah.
Why are they?
Why are they
Why
banned?
can't US companies get the access that the Chinese companies can get here in the United States? And if we're not going to play by the same rules, then why are we so open to allowing this to continue? I don't really understand that.
Well, on the flip side, you could say that China restricts the information that their residents can see, and the U.S. doesn't want to play by that rule, right? That they want to allow people to have say and have the freedom to go out there and to really view what they want to view. They don't want to have the same kind of censorship. So how do you not have censorship, but also give some discretion so that people understand the potential influences of manipulation?
I wasn't expecting to talk about TikTok this morning.
I've given a lot of thought to this.
It's interesting. It's a top risk over at Eurasia.
Yeah, and the reason why it's also interesting as a sort of organizational tool.
Fascinating. Everyone wants, communism so long as they can lead it. Everyone wants to be.
Do you want to be the leader of a communist nation?
The chairman of the Communist Party.
Chairman Ferro?
I'll do it better next time, after it went disastrously wrong last time.
How do you really feel?
We should continue this conversation that we were having in the commercial break. The tree graveyard that you see, the Christmas tree graveyard that takes place across Manhattan in the days after Christmas, where people just throw out their trees onto the street. I find that deeply depressing.
Why? Is it because it's the end of Christmas?
Too soon. It's so quick. It's so quick. Like December 28th, 29th, people just sort of throwing them out.
Are you the person who's saying Happy New Year at the end of January and still has a Christmas tree
No,
up?
I've just heard that Larry David apparently says January 7th is like the line. It's the cutoff.
And he's the authority on all
Without
things
a doubt.
etiquette.
He's the authority on this, yeah. The end of Happy New Year is January 7th.
The end of happiness.
Got no idea. The end of happiness. We're going that far. Wow. From New York, Good morning. Here's the price action. The end of happiness. What a way to start a morning show. Eh? Deeply depressing. You were bullish 20 minutes ago, and now we're talking about the end of happiness in 23. You know, there's a top risk at Eurasia. The end of happiness. Ian Bremmer's going to talk about it in a moment.
Number 11.
Futures right now up 0.4% on the S&P, on the Nasdaq up 0.6%. Into the bond market. Talked a lot about that CPI data out of Germany. You get the headline read in 30 minutes. We had the regional breakdown coming in softer than the previous month. You've got a bid into the bond market. 376.71 on a 10-year. Yields are lower by 10 or 11 basis points. Maybe it leads to fewer ECB rate hikes. I don't know. Euro-dollar looks like this. Euro-dollar weaker. Euro-dollar coming down to about 105.40. We're negative 1.2%, Lisa, on that currency pair.
And again, I don't know how this plays into weaker than expected or bigger than expected deceleration in inflation data over in Germany, because you would think that might support the euro. Hard to get a sense of what is going on other than perhaps then treating people getting back. Some interesting names. Tesla. This, to me, I found very interesting. They delivered fewer than expected vehicles last quarter, despite some of the incentives that they were offering. And they only increased their deliveries by 40% versus 50% over the past few years. Given the fact that Elon Musk has made such a big pushback against some of the discussion about the slowdown in their deliveries, this really raises some questions. One, is this a Tesla issue, or is this a broader automobile issue? Or two, is this going to be alleviated, especially with some of the supply chain issues and China reopening, workers getting back? Those shares down more than 4% in pre-market trading. Do you have any thoughts on that?
No thoughts whatsoever.
Okay, and then we also see Alibaba and JD.com. Those are rising.
It's a good start, isn't it?
Well,
I'm deeply distracted right now. You know, I closed out the show last year to go away for the holidays, and I often say this. I think I say it every single year, and I mean it. We have the sharpest, smartest audience on the planet, and they always keep me in check, and they're even keeping me in check over this. So here's the tweet. This is from January 4th, 2022. How does Ferro get his Christmas tree 5 decades in advance, only to then put a moratorium on Happy New Year after the first session of the year? Feeling part intrigued, part bitter. And then I'm getting, this is basically the tweet, and this is what they've got to say this morning. You can't flip-flop year to year like this. You know, is it the first session of the year, or is it January 7th?
Get with the program.
You know, seriously,
be consistent.
That is keeping me honest,
Ferro.
right?
Yeah.
So, I'm going with Larry David. I like the January 7th thing.
All right.
I think it's just like, that means if someone says Happy New Year to you, you can just blank them. So after that, so it's like, yeah.
Of course you like Larry David etiquette. This makes every sense in the world. That if anyone had any questions, there they are, all answered.
It's TK on those top risks over at Eurasia Group. Tom joins us now. Hey, Tom.
We're going to have a good conversation here, John Ferro. John, I first want to go to you with one of the insights. We can pick this up tomorrow when we're all three in the studio. To me, the shock of the last number of days was Spanish disinflation. It was a stunning trajectory. And I wonder, John, if that's just one tea leaf of an example of the disinflation pushing against where Bill Dudley has been for years, John. I think it's really important.
So, Tom, you see it in Spain. You're seeing it in Germany this morning as well. And Lisa and I have been talking about that all morning. Yeah. You'll get the headline read in about 26 minutes. I'm with you. But I think the same story applies to Europe as it does to the United States. Yes, we're coming off the peak. Double digits in Europe, but down to what, Tom?
Right.
Down to 7, 6, 5, 4. And how long are we going to stay there? And with that in mind, how much work does this ECB and this Fed, for that matter, have to do still in the year ahead?
In our debate to January 12th and that important inflation data, we're going to take international relations, the world of Ian Bremmer of Eurasia Group, and their top 10 risks for 2023, and fold it into the stunning accuracy of William Dudley's 2022. He absolutely nailed the trajectory away from transitory. He is the former New York Federal Reserve president. We're going to dovetail these two worlds of Bremmer and Dudley together. The stunning optimism from you, Ian Bremmer, is the United States almost didn't make your top 10 risks.
That's right.
That election changed your dialogue in the study of Dr. Dudley and all of the surveillance world.
That's right, because there was a tail risk. Even if low, it was a reality that the U.S. was heading potentially towards a constitutional crisis, that you would have an election in 2024 that was going to be fundamentally delegitimized, that Trump was likely to be the Republican nominee, that you would have people in positions of power overseeing elections, governor positions, Secretary of State, that were not, that were supporting a steal, that were supporting the delegitimization of a national transfer of peaceful power.
People spoke.
That's all gone. And it has nothing to do with the Republicans take the House, the Democrats hold the Senate. It's not about that. It's about the fact that the system responded to people that were clearly incapable of holding office and willing to break the system. And the resilience of American democracy brings the U.S. to only number 8 in the top risk list.
That sets us up with William Dudley here, of course, formerly with the New York Fed and writing for Bloomberg Opinion. Bill, in your essay today for Bloomberg Opinion, you focus on the fiscal. Part of the challenges here in the year forward is not so much a monetary impulse, but a fiscal impulse. How will that change the Fed's work?
Well, the monetary policy is still going to be tricky. How high do you go for how long, and how much slowdown do you tolerate? I think the fiscal is a big risk, so that it's not remarked on by virtually anybody. We're going to end this business cycle at a budget deficit of about 5% of GDP, which is a really horrible place to end the business cycle at. And that's before we actually get all the costs associated with higher interest rates on debt service and the costs associated with Social Security and Medicare as the baby boom generation retires. So I think the fiscal situation in the U.S. has deteriorated very sharply. Up to now, markets have been extremely tolerant about this.
Bill Dudley, I want to go back here, and it is a top 10 risk of media, which is the gloom out there. The world's going to end, and we're going to have the recession to end all recessions. Take us back to your study of recession history and guessing at Berkeley years ago. Can we actually guess a recession in 2023?
Well, a recession is pretty likely just because of what the Fed has to do. The Fed has to drive up the unemployment rate sufficiently to slow down the economy, to generate slack in the labor market, to bring wage inflation down to a level consistent with 2% inflation. But what's different this time, I think, is that if we have a recession, it's going to be a Fed-induced recession. And the Fed can end the recession by subsequently easing monetary policy. I don't think that there's a big risk of a financial instability cataclysm that pushes the economy into a deep recession. I think this is a recession where the Fed's has the controls. When they need to ease, they can do so. The challenge for them is to not ease too soon, but to ease in a timely way.
Bill Dudley, I've got time left for one question, and I want to bring it over to Dr. Bremer's study at Eurasia Group of our risks and our division. Is Republican or Democrat monetary policy, are they really all that much different?
End of the day, it's really about how you treat the independence of the Fed. Would you actually criticize the Fed through its actions, or do you leave it alone? The Democrats, really starting with Bill Clinton's administration, have been very hands-off on the Fed. Let the Fed do their job. Republicans, especially under the Trump administration, were much more combative in terms of instructing the Fed what the Fed should do. I think the Democratic approach is better because it keeps markets more calm, allows the Fed to be more effective in translating its actions in terms of the tightening of financial conditions that it needs to have to control the growth rate of the economy. But there is a difference between the two parties in terms of how independent they treat the Fed.
Too short a visit, Bill Dudley. Thank you so much for joining us. Ian Bremmer, a quick final word here. Where's the silent majority in America? I was watching some Spielberg movies this weekend and his wonderful new Fabelmans and all that. Where's the silent majority that Spielberg talked about?
The silent majority is stable. Silent majority is in the middle of the bell curve. You saw it on abortion. For 50 years, you had an agreement that basically it was going to be safe, legal, and rare. Suddenly, a majority of conservative Supreme Court justices decided they were going to undo that, and the population rebelled against that. And they said, no, 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 we don't want it to be everyone gets an abortion, and we don't want it to be everyone finds it illegal. We're going to force you back where we are as a country. And no matter how corrupt, no matter how many populists you have, no matter how much anti-establishment sentiment, it turns out that most Americans are actually in the middle.
This is really important, folks. And of course, with the Eurasia Group, I really want to say the pecking order of their top 10 risks is key here. At the top, Russia and China. You've got to go a long way down to see American risks. We'll continue this discussion from the offices of Eurasia Group in New York. John Ferro.
Hey, Tom, looking forward to those conversations. Tom Keene with Ian Bremmer and Bill Dudley just moments ago. They'll be catching up with Kevin Rudd, the former Prime Minister of Australia, in just a moment. And Lisa, obviously, front and centre is what's happening in China.
Yeah, especially because that does inform the growth outlook for so many other nations. It also has to do with the scarcity of different objects and different commodities, from oil, but also to grains, also to water, which is something else that the Eurasia Group points to. How much do we start talking about that later in the year when this year we seem to have avoided it?
Where does the demand show up? Where does it show up? Do we get the revenge spend from the Chinese consumer that we got from the US consumer and the European consumer? Where does it show up? Do they spend abroad? Do they spend at home? And how do you want to play this story? I don't think it's as obvious as maybe it looks at first blush when you really start digging a little deeper into all of this.
Especially because you think about all the people in China who are leaving to do revenge shopping at LVMH, at a whole host of different luxury goods stores. You start to see a real rebound there. Copper, that's been one area people have been watching. Copper prices rising pretty significantly, whether that might be the first indicator before even crude.
I was speaking to someone that knows way more about this than I do. China's reopening. It's a very different China from 3 years ago. It's much more nationalistic. And I wonder if that's what shapes the spending habits of the Chinese consumer coming out of this. Do you get that knee-jerk reaction into European luxury in the way that you might expect maybe a couple of years ago? Or does the money go somewhere else? That's what I'm asking. I mean, look at the travel restrictions, OK? And look at the tone that's coming out of the foreign ministry spokeswoman this morning about the travel restrictions that have been put up potentially across the whole of the West as they reopen. Does that basically shape things further and make sure that they spend that money domestically in China? And I wonder if it shows up in commodities. I'll wait and see. I wonder how much they've stockpiled over the last 12 months. We'll see.
You know what? These are all great questions. The nature of China will be very different also. Just all the people who had their adolescence completely obliterated by years and years of COVID restrictions.
Revenge spend on what is kind of my question into 23. Futures are up by 0.5% on the S&P. Kevin Rudd, the former Prime Minister of Australia, coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill, Kevin McCarthy's chances of becoming Speaker of the House remain in doubt as Republicans prepare to take control of the chamber. The GOP will hold only a slender majority when the new Congress convenes today. McCarthy can't afford to lose more than 4 Republican votes, and he's opposed by a number of hardline conservatives. China's new foreign minister praised Americans after stepping down as ambassador to the U.S. It's a sign that the ties between the two nations appear to be improving despite tensions over Taiwan. Jin Gang tweeted that he was deeply impressed by so many hardworking Americans. He pledged to help build a stronger relationship with the U.S. IMF Managing Director Kristalina Georgieva expects a third of the world economy to be in a recession this year. She told CBS News that's because the 3 big economies, the U.S., EU, and China, are slowing down at the same time. Georgieva says that if the resilience of the U.S. labor market holds, that would help the world get through a difficult year. More troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job for much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers plan to strike later in the month. Unions are demanding bigger pay hikes to deal with record inflation. And end-of-the-year discounts weren't enough for Tesla. Elon Musk's electric car maker delivered fewer vehicles than expected in the last 3 months. Still, Tesla handed over a record 405,000 cars. The company slashed prices in both the U.S. and China, its 2 biggest markets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Chinese economy is doing quite poorly. Zero COVID is a major contributor. There's supply chain disruptions. The Ukraine war is part of it. But he has to move to shore up the economy.
China reopening into a very different world. That was Max Baucus there, the former U.S. ambassador to China. Live from New York City this morning. Good morning, a happy new year to you all. Equity futures up by 0.5% on the S&P. Into the bond market, yields are lower, a whole lot lower. Lisa's gone through the data through the rest of this week. You'll get job openings. Is it tomorrow, Lisa? Yep. Jobs data? Yep. And then payrolls on Friday. Looking forward to that. Yields down by 11 basis points to 376 on a 10-year from Eurasia Group HQ here in New York. Let's get back to Tom Keene for more. Hey, Tom.
Hey, John Ferro, thank you so much. We're really looking forward to the 3 of us tomorrow in the studio as we drive to that jobs report on Friday and a critical inflation report January 12th as well. With us, Ian Bremmer. We celebrate at Eurasia Group their top 10 risks for this year. And beyond qualified to speak of the Pacific Rim of his Australia and China is a gentleman fluent in Mandarin, a PhD from Oxford on his studies of China, and most importantly, he is the new ambassador of Australia to the United States. The former Prime Minister of the nation, Kevin Rudd, joins us this morning. Of course, a commitment to the Eurasia Group pushing 10 years. Dr. Rudd, I've never called you that. Dr. Rudd, thank you so much for joining us today. What is the level of power of Xi, the opacity that Ian Bremmer talks about when we talk of China? What is your knowledge or perspective of the power of President Xi?
Well, great to be with you. I should correct the record slightly. I'm not yet the Australian ambassador to the United States. That happens in March this year. I'm still president of the Asia Society. 3 months before I turn into a pumpkin. That's why I'm talking on your program. Bottom line, in terms of Xi Jinping, is as follows. He is numero uno, numero duo, and numero tre in the Chinese political system. And if you wanted any evidence of that, you look at the 20th Party Congress, where anyone who did not come from his group within the party was given an exit pass. And instead, we had 4 people elevated to the Politburo who are virtually lifelong career colleagues, friends, and supporters of Xi Jinping. So his authority is great. However, this policy U-turn on zero COVID, which was executed on 7 December, will raise a whole series of questions in Chinese political circles about the fallibility of Xi Jinping's political judgments. And so therefore that does create a dent in the armor for the long term.
I look, Ian Bremmer, at this, and Kevin Rudd turning into a pumpkin in March is part of the issue. You can speak freely. What is that? We have an allied response in Europe. We have an understanding of how to respond to Putin. I don't perceive an allied response from Australia up to Japan or the Pacific Rim against China. Does it exist?
Oh, it exists. It's just no one's happy about it politically, because every ally understands that you don't want China to fail. Every ally understands that they're not happy with China's political economic system and maximum Xi, as Kevin and I describe it. And also every ally understands that we need to keep doing business with China, even though we're concerned about what our present level of interdependence and coupling implies. We know that we can't suddenly rip it up. Now, that underlying reality, which does align the United States with the entire G7, is very different from the political statements that need to be made by various leaders, because no one's happy with China. And scoring points off of China is very easy to do. And in between those two things, you have to find a policy where how are you going to hit the Chinese in ways that are absolutely essential to your national security without upsetting the entire relationship.
The distinction of this, and Kevin Rudd, this is so important, a question you'll answer now and not in April or May. Kevin Rudd, I look at the United States and a Republican and Democratic coalition against China. How should the United States advocate to the broader Pacific Rim if we're all on the same page in our distrust of Beijing?
Well, let's look at it in these terms. I'll challenge your premise before to say that there is not solidarity between US allies in Asia, to wit Australia, Japan, and the Republic of Korea, and partners as well, such as India, on, let's call it, the broad thrust of administration China strategy. And I think, frankly, Secretary of State Blinken, National Security Advisor Sullivan have done a good job in herding the cats, both in Asia and also, frankly, in Europe so far. However, for the future, what is the missing element in US grand strategy? It's called the economy, stupid. And that is, you cannot continue to assume that there will be collective solidarity on security questions, but on the economy, the United States happy to throw some of its allies under a bus. And for those reasons, the United States Congress needs to embrace instead a different strategy which opens its markets more to its allies in Asia and in Europe, despite the overriding protectionist sentiment of the US Congress and political class more generally.
Ian, that comment's so important. You want to jump in here with the time that we've got. Why is that such an important statement?
Kevin's completely right. It's very easy to not have a common economic policy for the United States with Russia because we are literally decoupling Russia from the entirety of the G7 economy. We are not doing that with the Chinese. China is extremely important to the U.S. economy, the German economy, the French economy, Japanese economy, the Australian economy. But we, the United States, do not have a trade policy. We don't have one. And so, as Kevin said, unless Congress, the Democrats, the Republicans are prepared to actually speak coherently about a long-term U.S. economic strategy, the national security policy by itself doesn't get you where you need to go.
In the time that we've got left, Dr. Rudd, very simply here, do you demand a weak dollar to assist the Pacific Rim?
Well, as a very polite Australian, we demand nothing. But my commentary would be as follows. That what we want above all is to ensure that the economies of East Asia remain market competitive and with greater and greater levels of access to the American market. That therein lies the future success or otherwise of US grand strategy. You cannot have a strategy which has one arm tied behind its back, namely trade the economy. You must, in fact, have both wings flying. Otherwise, this bird doesn't take off.
To 17th Street Northwest in Washington, he will travel in March. The future ambassador of Australia to the United States, Kevin Rudd, and of course with Eurasia Group for years. John Ferro, to me, and Lisa's been great on this, John, this Pacific Rim focus to me is the great theme of 2023.
Could not agree more, Tom. Couldn't agree more. TK, great work as always with Ian Bremmer there and the brilliant Kevin Rudd, diplomatic as ever. I want to take you to Apple just briefly. In the pre-market, the stock is up by about 0.5%. You get earnings from that company at the end of January. January 27th is when we get the much anticipated Apple release of earnings. I say much anticipated because that stock last year down by more than 26%. Last month down by about 12%. An ugly month for them. Leads to the supply issues, according to a representative of Foxconn, the big producer of iPhones out in China. They're back to 90%. The plant was shipping at 90% of the peak capacity forecast that they started the last year. So maybe things start to ease just a little bit more in the months to come. Demand picture. What does demand look like? Because there's a real conversation around that now in a way that hasn't been maybe in a couple of years.
Which really was highlighted by Tesla, because this was a demand issue. It wasn't a supply issue. They had leftover vehicles. How much is that really going to be reflected in what we see from Apple in terms of, yes, there was a supply chain issues, but it really was a demand picture that was crimping some of the potential sales and the reason why they were giving discounts.
The kitchen sink for the year ahead. Mike Wilson, Morgan Stanley, talking about the potential that you get the guidance and they have to guide lower, maybe aggressively so. Not Apple specifically, I'm talking about the broader equity market here coming into 23.
I don't envy anybody who has to come up with a projection for 2023. It is hard enough to get out to February, let alone December. It's hard to understand what potential risks could happen and, frankly, even where we are in terms of the inflationary cycle. If we do get disinflation ongoing in goods, does that lead to going back to 2% or does it lead to going back to a 4% inflation handle? And then what does the Fed do with that?
It's amazing how many people are lining up to say recession in 2023, global growth recession, all of the above. Let's look at some of the indicators right now in the labour market. You mentioned claims still in and around 200k. Let's see what we get in payrolls on Friday. If you look away from the labour market, and we can talk about jobs tomorrow, but jobs, 1.7 job openings per every American looking for a job, supposedly, according to the data. But again, away from the labour market, go to the market. Yield curve's been inverted for a while. Do you see that corresponding with any contraction in credit growth at the moment? Or is credit growth going the other way?
Well, right now what you're seeing is actually an easing in credit conditions. More people who are actually going in. You're starting to see a lot of bond sales over the past couple of weeks. Again, to your point.
This is the Neil Dutta argument over at Renmac. Do you actually get a pickup in growth to start the year as people line up to say recession is just around a corner? Futures right now up 0.4%, just around a corner. It's Troy Gajewski of FS Investments.
We're looking at a very shallow recession and very shallow credit contraction in 2023.
It's an open question of, will we have a recession? When will it be?
We're getting back into a more normal zone of consumer price sensitivity.
That kind of narrow path where inflation comes down quite a bit more than is widely expected, that's the camp I'm in.
The Fed and other central banks are going to need to maintain tight financial conditions through 2023.
This is Bloomberg Surveillance Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Go back to bed and stay there. I just got Peter Cheer's outlook over at Academy Securities. Look at this. Outlook, pain, in capital letters. I mean, that's all it says.
End of
It's just like
happiness.
one word for his outlook title. Pain. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Let's talk about some of that pain. Peter Cheer is saying not much help is going to come from the bond market. He's focused on the wealth effect. He says there is a chance for some geopolitical respite, but ultimately the revaluation is not done. That's the take from Peter Cheer. Lisa, this morning, pain.
Well, I think a lot of people do agree with him on some of this, but not necessarily the bond market part, because a lot of people are talking about bonds as offsetting some of the pain that you may see in equities. Peter's not basically saying that that's necessarily going to be the case, and I do understand that. It just sort of depends on whether you get the negative on that side or whether you still get some momentum.
Should we talk about a positive?
Yeah, let's talk
Downside
about
surprise.
that.
German CPI for December, 9.6%. The estimate was 10.2. Talked all morning about the regional breakdown of German inflation for the month of December coming through this morning, indicating we would get this shift lower. But ultimately, we're still close to double digits. This ECB is ready to go again. And looking at the guidance you're getting from ECB President Christine Lagarde again and again.
Well, and this is a reason why it's unclear whether we'll get the same kind of pop in equities, pop in risk assets in general, when we get a deceleration in inflation, because we all are expecting that. We are past peak inflation, or at least most people seem to agree. Now the question is, how quickly do we go down, and to what? And what does it require from central banks?
Yields are coming down this morning. Your 10-year down 13 basis points to 3.74. Let's whip through that 2023 price action. I've got to get used to saying the year 2023. I never got used to 22. Where did that year go?
I'm with you.
Ridiculous.
At least we know it's morning.
Happy New Year.
You could still say that.
Up 0.6% on the S&P right now. Equities elevated through most of this morning, though off session highs of about 1% or higher in some places. In the FX market, euro dollar 105.35, euro dollar down by 1.2%. It's one of those, isn't it, Lisa? It's early in the year. People start to come back to their desk. You see a move like that on euro dollar. You could sit here and say, oh, yeah, CPI comes in softer. Maybe people pulling back on ECB rate hike expectations. Or you could just say people coming back to work, and I'm not going to read into any of this too much too soon.
Or you could say people are coming back to work and deploying their theses, right? That perhaps we haven't seen peak dollar, that perhaps you go into bonds. And those seem to be the trades that we're seeing early in the morning. I don't know. Just if you're going to stick a narrative to it, it could be something like
Getting
that.
some dollar strength this morning. DXY close to 105. Joining us now is Troy Gajewski, Chief Market Strategist at FS Investments. Troy, let's start here just on the recession call. How can you make a call on a recession that people say is just around a corner when credit growth isn't contracting? In many places, it's expanding. Troy, can you make sense of that for us?
Yeah, we think in the short term, recession is still unlikely, right? Given the strength of the consumer still, as well as the incredible resilience of the labor market. You were reciting some of the data earlier about 1.7 job openings per unemployed person, a still very low unemployment rate. In the short term, you have money supply contracting driven by the Fed's QT and obviously an inverted yield curve. Yet you have credit expanding at the banking industry at really some of the most rapid rates in the post-GFC period. So, we think in the short term, meaning the next quarter or two, we stay in this nominal GDP dwarfing real GDP environment, right, driven by still elevated inflation, a continued galactic mean reversion between financial assets, most notably equities and to a lesser extent fixed income, relative to nominal GDP as well as the labor market. And if you think of the last 20 years, you've had such excessive degrees of financial asset outperformance driven by lower and lower interest rates, more and more money supply and globalization. And now at least two of those factors continue to go the other way and the other way hard. And interest rates is more debatable, right? We know we're going higher in the front end, but it's a reasonable debate whether the 10-year has peaked or not. We think there could be another higher high driven by, QT as well as, still elevated inflation prints. But it is a reasonable assumption by some that the back end of the curve has peaked in terms of yields.
In the muddle, Troy, do you have any strong convictions to start the year?
Oh, we have all sorts of convictions in terms of individual trades, right? I mean, if you think about in general where you want to be at this stage of a market cycle, you still want to be in that northwest quadrant, the efficient frontier, where you're taking less risk and you're maturely accepting, 6, 7, 8%. So two examples there would be senior secured commercial real estate lending strategies, where the headwinds of lower rates and tighter spreads now turn to tailwinds with wider spreads and higher rates because they're floating rate. Secondarily, if you look at multi-strategy funds, they're starting the year with more cash flow, more carry than coming into last year, and there's still ample volatility trading opportunities. And then if you look at higher quality exposures, we're really still leaning into interest-only strips hedged with pass-throughs, where both sides of the trade have positive carry. And with home prices ceasing to appreciate and now declining, if rates drop back down and drop back down fast, it's much harder to refinance when you have home price depreciation and higher LTVs than when you have a straight up, hockey stick like move in the housing market like we had for 20 and 21, or historically 04 and 05.
Troy, zooming out, because a lot of this is moving away from the macro calls and looking at specific, perhaps risk-adjusted returns that you see as favorable. Zooming out, how much does what we're seeing in China shift any of your assumptions, even when it comes to real estate, who's buying it, when it comes to rates, when it comes to the potential cost of commodities based on the reopening of the world's second biggest economy?
Yeah, so China, we think most in general have too high of opinion of their own opinion on how China impacts markets, right? China is always a very complicated place. People make grandiose calls all the time. It is encouraging to see them at least move through the COVID period and sort of end their COVID zero policy over the medium and short term. But obviously, that's going to have negative ramifications in the immediate short term. From our perspective, there's just so much to do right now in areas of the world, primarily the United States, where you don't have to be 100% correct in your China call to make money. And in general, in investing, you want to focus on strategies where, the probability of success is very high. And if you're wrong on one or two of your assumptions, you still make a reasonable return. If you happen to get all the assumptions right, you could have a slightly higher return. But the trajectory of China really isn't going to dramatically impact our highest conviction strategies right now.
Well, Troy, just with regards to China, how can you avoid that? Can you walk me through that? Because we might be sitting here talking about inflation kicking higher again, goods inflation picking up in a way that people aren't anticipating because we get this surge of demand into a constrained economy again. Troy, how do you get that call? Where do you make it where you can avoid the China one?
So for instance, if you're looking at senior secured commercial real estate lending, it's really simple right now, right? We had a very strong period of appreciation where you had tighter and tighter spreads, and you had lower and lower interest rates in the front end, which basically favored real estate owner operators in terms of the capital structure. And now, as the real estate market's turned, you're basically having a wealth transfer from owner operators to lenders, and you want to be on the right side of that trade. And so, whether China grows at 4.5 or 5, or reopens faster as COVID burns through the country, it's not going to affect the dynamics of banks stepping back from lending, of the CMBS market being partially closed, of a lot of other alternative lenders being a little bit tapped out on capital. This is a mega multi-year trend. If you look at IOs, for instance, or interest-only strips versus pass-throughs or hedge with pass-throughs or treasuries, ultimately the housing market is like an aircraft carrier. When it's going up, it takes a lot to drive it down, and vice versa. And what we saw, of course, is with the combination of the highest or the fastest rising mortgage rates of all time, coupled with very rapid price appreciation, we had affordability drop down below the previous record low of 2005, 2006. And so again, whether China grows at 3.5 or 4, it's really not going to affect that dynamic over the short term. Like if home prices drop by 20, 25%, sure, affordability's gone up, but that means refinance activity will have slowed down significantly if rates drop. In the event that mortgage rates drop very, very rapidly, again, that could change the dynamic of the trade, but it's highly unusual for any information come out of China to change those types of dynamics. So when you're trying to isolate trade expressions, we want to make sure that they're very macro resilient for this macro environment, right? Make sure you're positioned for strategies that do well in high nominal GDP, low real. and can withstand mark-to-market volatility in broader markets and an eventual recession, because we do think we'll enter that at some point later this year, early 24.
Troy, you make it sound easy. Never is. Troy
Yeah, no, that's for sure. It's never easy.
Hey, Troy, great to catch up. Happy New Year. Of FS Investments, Troy there, walking us through a couple of trades. I can tell you this, the primary market in credit wide open this week. Lisa, we've just gone through some of the numbers that the team here at Bloomberg put together. 40 billion is the number. Blue chip firms are expected to raise as much as 40 billion in the US investment grade market this week. How about this for a stat, Bramo? More than 4 times the volume for the whole of December. We expect that busy January. We always get it.
Yeah.
But December was pretty quiet, wasn't it?
That's what I was going to say. I mean, this isn't a really difficult comparison, considering just that nobody came to market in December. Everybody was away and prices were not ideal for the borrower. But for the lenders, they're waiting to lend, which is exactly the open credit markets that people are talking about.
The year of fixed income. You on board with that?
Maybe. Maybe not. No,
the starting point's different.
It depends what you're talking about in fixed income. And I think that that's the difficulty that Troy Gayeski was suggesting. You know, I love that my takeaway from that entire discussion was we're not even going to try to tell you what's going to happen on the macro side. Just hide as well as you can in different specific instruments on a risk-adjusted return basis that you can just basically avoid having.
I struggle to keep up with Troy sometimes. Sometimes it just totally loses me.
He's got a brilliant thesis, and he's looking at some very interesting areas. But the takeaway to me is you can't game out this macro environment. It is going to be a really whipsaw.
Tough.
Yeah, super
Massively,
tough.
super tough for 23. Anyone that makes it look easy, it's not easy. Futures up on the S&P by a third of 1%. The end of happiness in 23.
I was going to get it.
Bramo with a top risk for the year ahead.
That is a risk.
Amazing. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Disgraced crypto founder Sam Bankman-Fried plans to plead not guilty to fraud charges today. He's set to appear in federal court in Manhattan after being charged with orchestrating a years-long scam at crypto exchange FTX. 2 of Bankman-Fried's closest associates have pleaded guilty to fraud and are cooperating with the government. Germany is open to seizing Russian assets to help build Ukraine rebuild from the war. Now that, as long as legal issues can be resolved and allies are still on board. Still, not everyone in Chancellor Olaf Scholz's government is enthusiastic. Finance Minister Christian Lindner is concerned that confiscating Russian central bank assets could create a dangerous precedent. In China, the economy ended the year in a major slump. Business and consumer spending plunged in December, and more disruption is likely in the coming months as COVID infections surge across the country. Activity in China's services sector fell the most in almost 3 years. In the National Football League, Buffalo Bills player Damar Hamlin suffered cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals. Hamlin is in critical condition in a Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics. The game was postponed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Recession is pretty likely just because of what the Fed has to do. But what's different this time, I think, is that if we have a recession, it's going to be a Fed-induced recession. And the Fed can end the recession by subsequently easing monetary policy. The challenge for them is to not ease too soon.
That was Bill Dudley there, the former New York Fed president and, of course, Bloomberg opinion columnist, sitting down with Bloomberg's Tom Keene and Ian Bremmer of Eurasia Group on the top risks of the year ahead. Top risk for many of you, of course, is what happens with the Federal Reserve. And Bremmer, I've got to say, looking at the Fed, can we pick up on that line from Mr. Dudley that he used there? What's different this time is that if we're going to have a recession, it's going to be a Fed-induced recession. The Fed can end that recession by subsequently easing monetary policy. Of course, they can do that. Will they do that?
Yeah,
it's a different question.
Especially if inflation is still the preeminent concern.
Precisely.
Because if that's the concern, they're not going to want to go in the other direction for fear of exactly what we were talking about with the boomerang kind of up and down kind of inflation spurts.
The challenge for them is not to ease too soon. I think we all agree with Bill Dudley on that particular point. Or rather, the challenge might be for some coming into 2023, easing too late and taking their foot off the brake.
Just to give you a sense of where the market is, Fed funds futures are pricing in almost 0.5% of rate cuts by the end of this year, by the end of 2023.
That's the big argument,
This
right?
is the big argument,
Sure.
and the Fed has pushed back, and a lot of strategists say this is not going to happen. They're not going to cut rates, and yet that is actually being priced into the market right now.
We talked for a while, and we keep going back to this question, and it might sound boring, but I think it is the question to be asking Fed officials. Is the risk of doing too little greater than the risk of doing too much? When you heard Chairman Powell answer that question a few times going into year end, I found like the answer started to sound like a little bit more balanced. The November news conference, it was sort of emphatic, super asymmetric risk, no balance here whatsoever. Then it kind of shifted going into the end of the year.
Lael Brainard perhaps had a bigger influence on some of the rhetoric coming out. It is a good question, but I think back to our conversation with Troy Gajewski, where a lot of the big investors can't forecast what's going to happen in the macro world. Neither can the Fed. So this is the question. At what point does politics become a more preeminent concern than trying to game out a macro situation that is completely opaque?
Do you know what I'll be happy to talk about a whole lot less this year? Can we just park the Sam Bankman-Fried story? I mean, Shanali Bassak's dropped by, and Shanali's got to cover this for a living. I get it, Shanali, forgive me. But I'm so sick of this story. I just want it to go away.
I spent my New Year's Day rereading all the indictments. So you and I both, brother. So, you know, at the end of the day, there are a lot of charges being brought forth for him as well as his deputies. And by the way, we're not even seeing all of his deputies come to the fore here. For example, the former Alameda CEO, nowhere to be heard of or found. But today's a big day because today he will be going down to a Manhattan court and pleading, we expect, not guilty. That draws this out for another year or so for you, John. So this will take a long time should he plead not guilty to 8 criminal counts.
So talk to us about the timeline. What are we thinking about here?
Should he plead not guilty, then there's a process in which he will go to court. There will be a lengthy series of hearings. It will take a long time. The question is, does his plea change anywhere in that kind of time frame? This has already, remember at the beginning we were talking about how is this going so slow? Why is he doing all these media appearances? Why haven't the regulator said anything in the US, let alone abroad? Now we're at this place where things have moved so quickly since December 13th. That was the only just a couple weeks ago here that we saw that this indictment came out.
There was a headline that crossed just moments ago that Sam Bankman-Fried has asked a judge to redact the names of the co-signers on the bail agreement. There is a question not only about the machinations of this case, but who's backing him? Who is involved with him? Who are some of the people other than his parents, which also are interesting given that they are Stanford professors or were in the profession of law?
Yeah, and have worked with very big figures from Peter Thiel to Gary Gensler. So a lot of names here who know the Bankman-Frieds. But when you look at that idea here that you can't know who the co-signers are for this, there's a lot of frustration. This is a $250 million bond. He says he has $100,000 in his own bank account. This is secured by his parents' home, which is a very small fraction of that bond. At the end of the day, there's a lot of Sam's life that he himself has financed through FTX, which has been getting all of these allegations here about the money coming from customers.
Well, we've been talking consistently about not just this particular case, but the ripple effects through the crypto sphere, but also beyond, political sphere, as well as others. And I'm just wondering whether you still get the sense in your conversations that there is more on that front, or have we really seen the bulk of it, which seems to be, at least based on the stability we've seen in certain markets, it's already passed?
It's definitely not passed because, remember, there are a lot of bills sitting in Congress now. At the time where many constituents have lost money from FTX or Gemini or Genesis, and they're clamoring for their regulators and their lawmakers to get it together. These lawmakers, many of them have met with Sam Bankman-Fried. Many of them have taken money from Sam Bankman-Fried and his deputies. Some of them have given it back. But at the end of the day, there's no clarity. And FTX has lobbied for some of these rules. Binance has lobbied for some of these rules, at least the U.S. affiliates. So when you look at the range of influence of crypto in Washington, it gets really hard to parse what's the right road ahead.
Just briefly, what's happening with the rest of those political donations?
You know, one question that has come up is, are they subject to bankruptcy claims? How do you get the money back? It's been spent on media ads in some cases.
Whoa. Hold on a second. Are you saying that some political parties could file for bankruptcy in order not to return these?
No, the FTX bankruptcy, they want the money back for the creditors. And so what do you do with money that's potentially been spent? I think that's a weird question to try to suss out. Some has been donated to charity. But at the end of the day, whose money is it? And a bankruptcy court would argue that it is the creditor's money.
You find the most dramatic angle to every story, don't you?
It's in my nature. It's just, catastrophic thinking.
Hey, Shani, just on the timing of when we're expecting to hear about all of this today. 2 p.m. This afternoon. Okay, looking forward to it.
We'll have headlines on the terminal.
Sort of.
Real time.
Kinda, later. Okay. Bloomberg Shani Bassett, looking forward to that a little bit later this afternoon. She's looking forward to it. I mean, I'm kind of just... I'm just so done hearing about it.
Hold on a second. I just want to point out that you bring in this segment saying this is the most awful story. Nobody cares about this anymore. Can't wait for it to die.
I didn't say nobody cares
and then
about it.
I find an angle that perhaps is a little more dramatic.
Just hoping for it to go away.
It's just a balance. It's a balancing act.
People just obsessed with the personalities and the personal drama in all of it.
Well, I think that there is an issue of someone who is recognized as incredibly capable academically with an established group of parents and just a community around him who was the star of an entire industry that was highly speculative and pulled into question. And just the complete unmooring of his effort is fascinating on many levels.
Everyone's got to learn from that, right?
What do you learn? I mean, honestly, because if it's just straight out fraud, it's straight out fraud. I guess to do your due diligence, know your customer, know your lender, know your...
Totally, know your subject when you're talking to them and interviewing them. There are things, obviously, that you couldn't know. I just think you have to be careful about putting people on these massive platforms and bowing down to them as if they are some kind of new god in the world of finance. That's why I always find that a bit sickening. I've always found it a bit sickening.
I sympathise with that. So.
And then that's always this is my ultimate problem with the media and the way that these stories are covered, is that the person who shows the most deference to that individual is the person who gets the most access to that individual. And you'll see it across networks, who gets to speak to who at all times. And I've always found that hugely problematic, massively problematic.
I would agree with that. I will say that the only, sort of counterbalance, and I will say this as someone who tends to see things in catastrophic and gloomy ways, there is a place for recognizing and celebrating innovation. And it's hard to find that balance sometimes, especially when you have someone doing new things and there isn't necessarily a cohesive set of regulations or oversight that people are using. And you have to tread carefully, but you don't want to stifle innovation too much either. And I'm talking not as just a journalist, but just in general. How do you strike that balance? And I think that right now, in the way that different banks and financial firms are talking about Bitcoin and crypto, you feel that hesitance, not wanting to really step on the innovation, the blockchain aspects of it, while also condemning outright fraud and really highly speculative types of activities.
This was fun. It's good to be back. Yeah, of course. It's good to be back. I was happy to be back.
I'm actually really happy you're back.
Did I look upset to be back? I was happy to be back.
No, you actually looked happy to be back.
I was happy to be back. It's good to see you.
Happy
Tom's going to be back tomorrow. Happy New Year to you. We'll do that for 6 more days?
4 more days.
According to Larry Davis.
It's January 3rd.
Of course, yeah. 4 more days.
4 more days.
Yeah. I've just forgotten how to do basic addition and subtraction. Jim Karen and Morgan Stanley, Sabadra Japra, Soc Gen, Citigroup, Stuart Kaiser, all coming up in the next hour on Bloomberg TV.
Happy New Year. Welcome back. This is Bloomberg Surveillance. John Ferro off preparing for the next hour. Tom Keene out on assignment. We are looking at markets that are trying to lift both in stocks and bonds to start a new 2023. There is a pessimistic tone over all of the strategists' notes, although this morning there is an optimistic tone in markets, at least U.S. markets in particular. 0.5% gain on the S&P. You could see that dollar regaining strength. The euro dollar 105.56 and yields sharply lower. 10-year yields 3.76%. A lot of this comes as people are getting more optimistic about the idea of perhaps disinflation. We saw that over in Spain. We saw that in Germany this morning. People are thinking that perhaps we've seen a peak in interest rates and that there is an inevitable recession, a soft recession that's going to enable everyone to go into bonds, and it will be all great. Stephen Rasciuto perhaps has a slightly different take. He's joining us now, chief U.S. economist at Mizuho Securities, and I love this. We're talking about all the gloom and doom, and you say, a Shakespearean comedy, not a tragedy. Why?
Well, I mean, the part of it that I think is the comedy is the fact that we keep on going down the same path, only to discover that the data is not justifying the path we keep going down. And the Federal Reserve, I think, is rationally looking at the data and making the presumption that the market is going in exactly the wrong direction. And I think this is what drives it. I mean, the comedy of it aspect of this is this is going to be something we're going to continue throughout most of 2023. And we're not going to get the tragedy of a credit-related recession. We're going to have an inflation recession, which is a long, shallow economic contraction.
Well, I think a lot of people probably aren't laughing after hearing that. There is this issue that you see in terms of an increase in spending in the fourth quarter, despite people expecting there to be a slowdown, doesn't seem to be edified in just the consumer appetite. Is this going to lead to a stickier inflation, perhaps a rebound, even in goods inflation, despite some of the calls for outright deflation by some?
Well, I mean, there are a lot of real fundamental issues that are going to be pulling down inflation. A, the base rate effects. Two, the lagged effects of a very, very strong currency. And three, what we're seeing in terms of the energy environment. Now, the energy environment is the most volatile piece of the equation. Additional cold weather could easily lead to a very sudden, sharp spike in energy prices that could have an effect on the monthly inflation numbers. But I think in general, we are going to see inflation come down. The movement from the very high inflation that we saw to the 4% area, I think is very, very justified in here. How we get from 4% to 2%, which is the inflation target of the Federal Reserve, is the problem. And this is where the chairman made it very, very clear in his last discussions after the FOMC meeting, that basically you have an environment where 65% of the components of inflation are heavily driven by wages. And therefore, you have to pay very, very close attention to what's happening in the labor market. And this is why they need to ease up the labor market in order to be assured that they can get inflation back to 2%.
Although, can they do that? And this is really the question. We get JOLTS tomorrow, the job openings data in the U.S., and on Friday we get the non-farm payrolls. What we have seen is not just in the headline numbers, which have been noisy, but the underlying components of wage gains, of other types of vacancies. It just doesn't seem like it's loosening all that much. Can Fed policy really achieve that, given some of the fundamental structural mismatches, a lack of labor, and a demand for jobs?
Well, it can, to the extent that you're willing to exercise demand management, which is something the Federal Reserve hasn't really had to do since 1990, because we've had credit-related recessions, and therefore we've had very, very different types of business cycle environments where the Federal Reserve was forced into a position of subsidizing the economy. And that, I think, is a critical component here. We're not going to have that kind of credit-related contraction in the economy, and therefore the Fed can exercise demand management more so than they have since 1990 forward.
So right now, as we look out, do you think that the market is getting wrong the potential downturn in the first half of the year? Or do you think that it's about right and that will be driven by perhaps some of the caution in spending by companies and just generally a softening that perhaps hasn't shown up in the consumer spending data?
Well, again, I think the recession will be long and shallow, and I think it could happen later than people anticipate. But the problem for the market is more where the market is discounting the peak in the federal funds rate and where the market is discounting the pivot from tightening to easing. I think the pivot from tightening to easing occurs much later in the recessionary environment than most people are anticipating, because since 1990, the credit-related recessions we've had have forced the Federal Reserve to pivot even before the recession actually began to become manifested fully in the economic data. And that's not going to happen this time because there is no underlying credit asset liability mismatch that's dominating the overall environment in liquidity in the economy. And this is where the market has a disconnect.
In this long and shallow recession, there's some structural changes that have been going on, or at least this is what people are talking about. And among them is a reshoring or an onshoring that some people are expecting, a sort of changing in the supply chains. Do you buy into that story as China eliminates their zero COVID policy and manufacturing gears up over there? Do you still think that companies will continue to redirect some of where they produce things to more local areas?
Good question. I mean, I think the point is very, very simple. It can be answered very, very simply. As long as corporate America and CEOs are paid on shareholder value, they have to find the lowest cost producer for any product. That doesn't mean they won't have some diversification, some upward adjustment that's taken place in terms of prices that will allow them to have diversified their production pipelines a bit. But at the end of the day, they have to go to the least cost producer. And if that least cost producer is China, that's where they're going to buy the bulk of their goods from, because they have to drive shareholder value in order to get paid. And that really is a fundamental principle that has not changed in here, despite all the COVID-related environment. Shareholders aren't going to sit there and say, you know, I'll really accept 5% in my earnings growth as opposed to 10 so we can have our product being produced locally. Shareholders are going to want the 10% return because the reality is everyone's in a 401k. They're in a defined contribution retirement program, not a defined benefit retirement program. And therefore, they need to worry about their future potential of earnings and their future potential with their stock prices.
Stephen Rasciuto, really intelligent analysis there. Stephen Rasciuto of Mizuho Securities, thank you. Earlier this morning, Bill Dudley caught up with our own Tom Keene and Eurasia Group's Ian Bremer, talking about what he expects the Fed to have to do. As former New York Fed president and Bloomberg opinion columnist said, take a listen.
Recession is pretty likely just because of what the Fed has to do. But what's different this time, I think, is that if we have a recession, it's going to be a Fed-induced recession. And the Fed can end the recession by subsequently easing monetary policy. The challenge for them is to not ease too soon.
Whether it's a Fed-induced recession is one question. Whether the Fed can end said recession that's expected by lowering rates is also another. Michael McKee joining us right now, Bloomberg economics and policy correspondent from Washington, D.C. Mike, I just want to start with the labor market and whether you could end up with a recession that's Fed-induced that doesn't include a material softening in a labor market that we get a lot of indicators for that seem to be showing a lot of strength.
Well, I think Bill, in his column today, explains it well. The Fed is looking at service price inflation, which is being driven by lack of workers in the service industries. And so as long as wage pressures stay high, that would be the thing to watch for on Friday. As long as wage pressures stay high, the Fed has to keep conditions tight. If we start to see them come down, Bill says 3 to 4% on an annual basis. Most Fed people are looking in the 3 to 3.5% as a sustainable level of annual wage increases. If we get to that point, then the Fed can start to back off. But I think what you're going to see is this tug of war between average hourly earnings, sort of driven by the fact that we don't have enough workers, and the Fed trying to slow the labor market. Interestingly enough, you look at the forecasts for this month, and Lisa, I think economists are just at the point now where they're sort of guessing because everybody is expecting the labor market to loosen, and it hasn't. So to say 3.7% is going to be the unemployment rate again in December is probably more of a guesstimate than an actual forecast at this point.
Well, it's definitely a guessing game, and I think everyone's pretty humble about it heading into 2023, or they are saying that they ought to be, considering just how many vagaries there are. I'm curious, though, and John's been asking this question a lot, which is the balance of risks, whether perhaps the Fed is worried about going too far or not far enough. Clearly, they are still concerned about inflation. They need to get it under control. When do some of the political concerns about a loosening labor market, when does that start to take a little bit more preeminence in Fed deliberation?
Well, the political aspect of it is something they're going to steer away from, at least publicly. They know that they have to be the bad guys here, and they know that unemployment is going to go up. If you push unemployment up by just a percentage point, you're looking at 1.5 million jobs lost, and that is going to be a human suffering story that will get a lot of coverage, and there'll be pressure on the Fed, but they're going to have to go ahead with it because they know that if they don't, then inflation gets embedded and it gets much harder to get rid of it, and they have to put even more people out of work. The interesting question is, because we're coming from such a low level now, we got to 3.5% unemployment, what is the ultimate unemployment rate that will be consistent with the idea of sustainable labor market wage increases. We don't know at this point. And so the Fed is going to be flying a little bit blind here. I thought Steve Risciuto made a very good point to you that we may see the Fed react more slowly in the case of a recession because they want to be sure of what's going on. And it's going to be hard to get a clear look at the data, that, at least in terms of what they think is going to happen going forward.
Which is not exactly what the market is looking for, considering that rate cuts are being priced into the market later this year. Mike, you are in Washington, D.C. We have a slew of data, a slew of indicators coming out this week. Next week, we get CPI. What do you think is going to be the most important indicator to start 2023 having to do with Fed policy?
Well, this week it's obviously going to be jobs because everybody's looking to that wage component and what's happening with service industry employment in particular. But CPI is going to be probably the market-moving number of the month of January. We're expecting it to continue to slow down, especially with energy prices coming down. But what's going to happen with housing and some of the other underlying inflation issues that the Fed's been watching is going to be really important to Wall Street. They're going to really react to that. One thing to keep in mind, too, and I think Mr. Dudley points this out in his column today, is that this is January, and this is when wages reset, when minimum wages go up, and when the government Social Security payments rise. And so there's going to be a lot of additional fiscal impulse coming into the economy, and we'll have to see how that affects the data.
Michael McKee, thank you so much, and we'll be looking forward to catching up with you as we get all of that data. Coming up next, Mariachi Shaki, Director of International Policy at Stanford University, speaking with Tom Keene over at Eurasia Group. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill, Kevin McCarthy's chances of becoming Speaker of the House remain in doubt as Republicans prepare to take control of the chamber. The GOP will hold only a slender majority when the new Congress convenes today. McCarthy can't afford to lose more than 4 Republican votes as he's opposed by a number of hardline conservatives. IMF Managing Director Kristalina Georgieva expects a third of the world economy to be in a recession this year. She told CBS News that's because the 3 big economies, the U.S., EU, and China, are slowing down at the same time. But Georgieva says that if the resilience of the U.S. labor market holds, that would help the world get through a difficult year. China is vowing to hit back at countries that place COVID travel restrictions on its travelers. A foreign ministry spokeswoman says some of the restrictions lack scientific basis and were imposed for what she called political goals. The U.S., Japan, and some other countries, they are requiring travelers from China to show a negative test before allowing them to enter. And more troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers plan to strike later in the month. Unions are demanding bigger pay hikes to deal with record inflation. And the U.S. tied Qatar as the world's top exporter of liquefied natural gas last year. It's a milestone for the fast-moving rise of America as a major supplier of the fuel. The U.S. only began exporting LNG from the lower 48 states in 2016. The shale gas revolution and billions in investments in liquefaction facilities made the difference. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
I think the last year has been, and I think you'll see continuation of this year, very impressive in terms of European action, solidarity, and transatlantic bonds. I don't think, or I'm fairly certain, that Mr. Putin had not counted on that. He was fundamentally wrong, and now he's gradually paying the price.
A new year, but a lot of the same problems. That was former Prime Minister of Sweden, Carl Bildt, talking about the war in Ukraine as it grinds onward, creating more uncertainty in the year ahead. That's one of the main risks facing 2023, according to Eurasia Group, where Tom Keene is, and has been checking in with a bunch of luminaries to really get a sense of where their heads are at to start a new year. In the markets, we are seeing a bit of optimism, perhaps, on the first trading day in the United States, with a lift of about 0.5% on the S&P. You're seeing a bid into stocks. You're seeing a bid into bonds. Yields lower by 12 basis points, 3.75% on that 10-year. A lot of people expecting that to go much lower throughout the year as recession fears creep in and dollar strength preeminent after a lot of weakness, perhaps trying to recap a bit. The euro softer versus the dollar, 105.67. Right now, let's head back over to Tom Keene, who is with Mariachi Shake, International Policy Director at Stanford University. Tom.
Lisa, thanks so much. Let's sell this forward, folks. And I talk about a book of the year or a book of the summer in that. This is the 27-page brief of the year every year in January from Ian Bremmer and Eurasia Group. And I really can't say enough about the themes. Obviously, we speak of Russia, of China. The conversation with Kevin Rudd as the next ambassador of Australia to the United States is one example. But far more, it's about many, many other topics that you see of those top 10 risks, including a focus on energy and a focus on technology this year as well. Not even mentioned this morning is Iran, which I think is exceptionally interesting and ties in, dovetails in to what we see in Russia and China as we do. Now, the next coming days, we'll give you coverage on this. And very importantly, we'll drill down to some of those top 10 risks that are a bit different. We have a perfect guest for that right now. Mariachi Shake is at Stanford University. That barely describes her definitive expert on thinking about technology and what it means for her Europe, and far more what it means for all of us around this world. And Professor, thank you so much for joining us this morning. We have seen the use of technology in the war in Ukraine, the speed of information, and for that matter, the use of technology as part of military operations. After what we witnessed in 2022, this time, are we tech different? Is this time tech different?
Well, we see an acceleration of the use of technology in almost all aspects of our society. You mentioned the ongoing war, the unjust war in Ukraine, waged by Russia, where technology plays a role cleverly used by the Ukrainians, but also when it comes to efforts to cause harm through cyber attacks on the Russian part, which should really prompt us to ask ourselves, when do wars really start? Is it when tanks roll over physical borders, as Russia has done, or is it when civilian infrastructure, critical infrastructure is targeted with cyber attacks, which we've seen for much, much longer than since February 2022. Then there have been remarkable events in the last year. Of course, Elon Musk owning Twitter now and using it as his personal playground, it seems. Breakthroughs in generative AI. Some of you may have been playing with that over the holidays. You know, those chat bots that can help generate texts. I know some students are trying to have their homework being done for them. But all the fun and play with those new applications of AI can't really disguise the new risks that these AI applications also bring for spreading disinformation or more sophisticated spam, for example.
Mariachi, I can tell you from Europe that there's an American tradition to Stanford University in Palo Alto for students to figure out how technology can do their homework. There's a history of that, to say the least. Let me talk about, and this is Cyber in 60 Seconds, what you're doing with Dr. Bremmer at Eurasia. After what we've seen with Sam Bankman-Fried, Binance and all, and what we see in Europe, our fear of cyber, do our institutions have control of technology, or is it in its reality as uncontrolled as we all feel?
Well, the question of control is a political choice. I think that is a very important thing to keep in mind. In Europe, the choice has been made to invest in regulatory initiatives, innovations, new ways of having oversight, transparency, and accountability. But in the United States, not as much. And I do think that the whole FTX meltdown, but also Elon Musk on Twitter, beg the question, will Congress finally step up and act?
I mean, this is so important, and let me ask you. I need to make some headlines here on a slow Tuesday morning. Mariachi, can Europe halt Elon Musk's experience at Twitter? Does Europe have the regulatory will to say to Mr. Musk, no, that's not acceptable behavior. You can't do that in Europe?
Absolutely. The laws that apply in Europe will apply to Elon Musk and all other CEOs of tech companies as well. So when he decides that he would like to, for example, allow the spreading of hate speech or other kinds of harmful content, if it's against EU law, he will not be able to get away with it just like that for European internet users. He may face fines or questions about transparency over his algorithmic settings. And so the EU has taken a number of steps, some of the legislation still needing to enter into force, others already on the book. And Musk, like everyone else, will find out that the law applies to him as it does to everyone.
Professor Schottky, I want to go to where Ian Bremmer is in his 10 risks of this year, which is a discussion of TikTok. And I am certain that every American listener and viewer want me to ask one simple question. Should we fear TikTok that our kids use? Should we look at TikTok, whether it's used by undergraduates at Stanford down to little children? Should we fear that as some form of pipeline or conduit to institutions or authorities in China?
Yes, we should not be naive about it. No one should be naive about the use of data, the harvesting of data as they use social media, whether it's on TikTok or Facebook or YouTube. And I think for a long time, it was American companies that dominated this market elsewhere. As a European, I can say we were first flooded by Facebook, Instagram, YouTube, Snapchat. Now, TikTok, of course, is very popular with kids here too. But the concern about where the data goes, who has access, what kind of profiles can be built about our children, about ourselves, what might these be used for, that is not all about fun dances and jokes and snappy videos, is something that I really hope everybody will make time to look into, because incident after incident reveals that misuse of data, commercial harvesting and selling of data is leading to all kinds of malign uses, whether it is commercially driven, politically driven, or actually worse, criminally driven. And so there's just really, I hope in 2023, no more room for naivete about how data is used.
Blistering. Marcia Schottky, thank you so much with Stanford University and far more her public service to European political systems. Can't say enough about that. Lisa, this has been an extraordinarily different top risk of Eurasia Group. I'm so glad we're going to focus on this Wednesday and Thursday. I believe David Weston will be with Jane Harman on Friday. That's a good thing on balance of power. And what's so different this year, Lisa, is how the U.S. is really not on the risk radar, as Dr. Bremmer said, because of that stunning November election.
Yeah, although there is still this concern about fissures. Just want to pick up on what you were talking about with ChatGPS, that bot system that people are using to do their work. My son has informed me that so far it is not yet good enough to write their papers, but they're, I'm sure, trying. Just theoretically, Tom, as you know, it's a profession.
I'll leave you here, Lisa, but all I can say is we're a long way from Cliff Notes. Not that I ever used Cliff Notes in school. That never occurred. At least on Thursdays, that didn't occur.
Tom Keene, thank you so much for all the work there. And I look forward to seeing you back in the studio tomorrow, where we can be reunited to start 2023. Coming up on The Open at 9:40 a.m., John Gray, the Blackstone president and chief operating officer, will be joining after a recent announcement they just put out moments ago. We are right now seeing a lift to markets to start 2023, the first trading day of the year, which we will probably learn very little about the macro environment, but we will be watching as people pile into bonds, the big year of bonds. That's what a lot of people think. From New York, this is Bloomberg.